So good morning, everyone, and welcome to our last day. So first, I want to say that I had to rearrange my presentation for this morning just a little bit, and I also had to add a couple of slides because last night I realized that what I wanted to show you, unfortunately, I had forgotten to include certain slides, and they're going to be very, very important. But if I'm not mistaken, and the chair might correct me, we have a pretty lengthy, session this morning. So, please, ask a lot of questions, and I also ask, also the panel, to come in, at various points, and because I like their point of view as well. Okay, so this is one of the key aspects when we're looking at the financial accounts, and how we're going to actually, make sure that they're coherent, consistent, balanced, and ready for publication. Good. The switch. Maybe we'll figure after the third day I might know something. I just want to make sure that. Sorry, I just want to make sure that I'm going to be ready for the interpretation. English is done. We're good. All right, great. Okay. There you are, me. It's me. So I'm going to ignore the outline because, like I said, I've rearranged a couple of things, but it's not important. Right. So before we start talking about the balancing of the current and capital account, I want to go over a couple of concepts, in the financial accounts. Okay. So the first thing that I wanted to make sure that, we all remember here, with this slide, what it shows is that financial assets must equal financial liabilities. So if you remember on the first day, what distinguishes a financial asset from a non-financial asset is that a financial asset has to have a counterparty liability. Okay. So what does that mean? There has to be a creditor-debtor. And as I said on the first day, because of this condition, financial assets are not going to add to national wealth. So when we look at the global wealth, they cannot add to it. So when you look at, for example, the wealth of a nation, it's basically the non-financial assets are the key, plus claims or the net claims on non-residents, whether non-residents have a claim, on the domestic economy, or the domestic economy have claims with non-residents. But when we take that at a global level, that gets eliminated as well. Okay. So in this slide here, what I showed, this is just for the domestic economy, but we're going to see in the next slide, we also have to put in the rest of the world. You could see that for mortgage assets, which is going to be part of the loan instrument category. And the reason why, I like showing mortgages, because I find people, can relate, because when we just talk about a general loan, loans consist of different types, of loans. You can have, short-term loans, you can have long-term loans, you can have credit cards, lines of credit, so they're all different. So I like to speak to something that, people can actually relate to. So we're looking at mortgages. And as we said, in the last couple of days, when you're going to be, structuring, the accounts for your economy, yes, we're recommending and we're hoping that you definitely are able to provide the 8, categories or instruments that we want. However, you can also then, use different subsectors or sub-instruments, if you will, within, okay? And that's going to also help your users. So in this category here, you can see that the total mortgage assets are 19.714, and the total mortgage liabilities are the same. So the condition is satisfied. But then when you look at within sector, that condition doesn't have to hold. So when we look at, for example, the mortgage assets of households was 137 units, but the liability of households was 13,867 units, right? So here, basically, you can see that household borrowed more mortgages than they have assets. And if you're wondering, how can a household have mortgage assets? Well, what usually can happen is that, a parent, might, lend money to, a child, etc. Okay, so that does exist. As you can see, it's very, very small. All right. Okay, perfect. Now, across all sectors, all transactions in financial assets must equal all transactions in financial liabilities. Okay. So again, you see here the total all sectors is 284,436, and you have the same corresponding liability. Now, if we look at the transactions in financial assets by households of 8,731, and we look at their liabilities of 23,463, if you take that difference, that is, what do we call that difference? So does somebody remember? What's it called? Sorry again?
It is written on your slide. It is net financial investments.
Right, net financial investment, but net financial investment also, because we always talk about, in the current capital account, we have the B9, net lending, net borrowing. So this is the equivalent from the financial side. Okay, so in my slides, I'm going to be referring to this as the net lending borrowing number 2, but it's coming from the financial asset side. Okay, so in this example here, you could see that households, were net borrowers. Nonprofit institutions serving households were net lenders to the rest of the economy. Non-financial corporations similarly were net borrowers. Financial corporations, net lenders. General governments, net borrowers. Non-residents, net lenders. So what that means is that certain sectors didn't have sufficient enough funds, okay, to acquire their non-financial assets. Okay, so the resources, were not sufficient enough for their uses. Okay, and to understand what we mean by the sources and uses, another way that you could compile the financial accounts is by this concept here, by looking at the sources of funds and the uses of funds. So what are the sources of funds? Your savings, right? Net borrowing. Now you can, if you sell any assets, that's going to be a source of funds, right? And it could be either financial or non-financial. And then what are the uses? So what did you use the sources to buy? Gross fixed capital formation or investment in tangible assets, net investment in financial assets, or you could reduce outstanding liabilities. Now, the financial account is not presented in this format, but if you have this concept in the back of your mind, it's always going to help you, okay, when you're looking at transactions. And it's also going to help you, when you're thinking about coherence, in the system. So we're saying here the source of funds must equal the uses of fund. And what are the sources? Their gross savings, which is denoted by GS, plus the external sources, net increase in liabilities, right? What are the uses? Gross capital formation, plus the net increase in financial assets. That mean? So if we rearrange this equation, so if you have gross savings minus gross capital formation, that has to equal the net increase in financial assets minus the net increase in liabilities. So the GS minus gross fixed capital formation is the net lending borrowing balance that you get from the current capital account. Similarly, the net increase in financial assets minus the net increase in liabilities is the net lending borrowing that you're going to derive from the financial accounts. And this applies to the whole economy and to each sector. Okay. All right. Now, in the balance of payments, the difference that we're going to get is called the net errors and omissions. Okay. Similarly, when we look at the national accounts, the discrepancy at the total, if you're able to compile, income-based expenditure, income and expenditure-based GDP, it's called a statistical discrepancy. Okay? The same thing. Now, savings has to include the rest of the world. In order to ensure all sources of savings are matched to total net acquisition of produced and non-produced assets, you have to include the savings of the rest of the world. Okay. So for a deficit in the current and capital accounts, debits over credits, there's a balancing net increase of liabilities or a reduction of financial assets, which is shown in the financial account. And here it's very, very important. Only by including the rest of the world does the whole system balance. And let's see this. Now, before we'll show you something, arithmetically or with numbers, we've spoken in the last couple of days that, these differences arise because of numerous factors. Some of them are because the current and capital account use different sources of information than the financial accounts. There could be data gaps, either above the line or below the line. There could be mismeasurement, of certain activities. So for example, when it comes to mergers and acquisitions, they're complex, transactions, and something could be missed. Or compilers have made a mistake. They forgot that, we need 4 entries, for every transaction or for every entry, in the system. And of course, revisions. Now, some of these, differences, and these differences apply not only to a centralized statistical office, but also to a decentralized framework. So it doesn't mean that this only applies, for example, if the central bank, produces parts, of the accounts and the statistical office produces the other parts of the accounts, or whether all of these are produced, within, one central body. Now, some of these, could be minimized and reduced. So when we look at, let's say, for example, revisions, you have to talk to your counterparts and ask them, what is your revision policy? Does your revision policy comply with our revision policy? What happens in some countries is that because of different institutional environments and practices, one institution is going to revise on a daily basis or live. Another institution is going to have a very strict revision policy. Now, when you're trying to join those two measures, immediately you're going to see that there's going to be problems. One institution has much more up-to-date current information, which they incorporated into their system, whereas the other one doesn't. Now, when the other institution has the opportunity to open up their system and accept those revisions, then everything should be back in line again, right? However, if you communicate and you can coordinate when you're going to undertake revisions, then you can minimize this issue. Similarly, with other activities, when it comes to mergers and acquisitions, it's essential that the balance of payments compilers talk with the national accounts compilers. Usually when we see mergers and acquisitions, they usually involve non-residents and the domestic economy. And it's essential that both of these compilers talk and make sure that they understand what needs to be done to be able to record that entry correctly in the books. Similarly, you can have problems when it comes to valuation. Sometimes, the government finance statistics is not following the 2014 manual, and they're on a cash basis. Whereas, the national accounts and the balance of payments are striving for, a more accrual basis. So there's going to be timing problems. Okay? And if that happens, it's going to also impact your GDP estimates, right? Because if your government is on a cash basis, remember, compensation of employees includes more than just wages and salaries. If it's a defined benefit plan, that defined benefit plan, if it's on a cash basis, is going to be recorded differently than if it's on an accrual basis. Okay, so right there, you're going to see there's going to be a huge difference in the savings, whether it's on a cash or it's on an accrual, and then how that's going to be reflected in the financial accounts. Okay. All right. So what I tried to do in this slide here, they're saying, well, sectors 1 to 4 are the domestic sectors. I mean, if you would like sector 1 to be households, that's fine. And NIPIsh, sector 2 could be, corporations, non-financial. Sector 2 again could be financial. Sector 4 could be government. Okay. So when we look at the first row, savings, you can see that each of the sectors have an estimate for savings. Sector 1 has 14. The total savings for the domestic economy is 37. When we look at the balance of payments, there's also savings of 5. So the total economy, including the rest of the world, has a gross savings of 42. Then, so that is basically what we said is the sources, correct? Now, when we look at the uses, which is here shown, is denoted as NFCA, which should stand for the net acquisition of produced and non-produced capital. You see that for sector 1, they acquired a net acquisition of 12. So now they have a surplus of funds which they can lend to the rest of the economy. And you can follow that all the way through. So at the total domestic economy, we see that there's a shortfall of -5. So the uses exceeded the sources by -5. But one of the conditions is that this has to equal 0 in theory. So we also have to include the savings coming from the rest of the world. And once you add that, then you got to balance 0. Now, why is this important? Okay. This is very important because now you can see that the statistical discrepancies or the errors can come from any sector. And in order for you to satisfy this equation, right, it has to balance to 0. Okay. So for instance, if there's a very, something exogenous is happening with the rest of the world, and the balance of payments compilers are having, a lot of difficulty, balancing, the current capital account, the balance of payments, they might have a very large discrepancy. Now, in order to satisfy that very large discrepancy, it's going to have to be taken into account by a domestic sector. Okay. Now, some countries, as I think it was yesterday, I heard are very orthodox, and they're going to make sure that this is 0. Other countries might decide, well, we might want to have a certain threshold. We want to make sure that maybe it's, a certain percentage. And they would like to stick to that percentage. But what happens is that sometimes you have to be able to be more flexible. So for example, if you had the strict orthodox principle that you had to make sure that the whole economy, including the rest of the world, balances to 0, during the financial crisis, of 2008, you would have had a really hard time. Yes, mathematically, you can make this thing work, but what is it going to mean for the actual estimates in order for you to get this, discrepancy down to 0? Okay. And then you have to contend with the discrepancy that's going to come from the financial accounts. Because as you saw in the previous slide, the financial account now is going to be looking at these entries from the financial perspective. And because they're going to have different judgment, different data sources, all the other factors that we mentioned previously, they're going to get now a discrepancy as well. So when you look at the discrepancy coming from a financial account, for the sectors, it's slightly different than you have for the current and capital account. Okay. And now again, this is now, it's going to have to be sort of like a discussion that you're going to have to take as, institutionally to decide, well, what are we going to do here? Are we going to make sure that the error is zero? Across all sectors, the horizontal? Is it going to be balanced perfectly vertically? So as you can see here in sector 1, the net lending borrowing is 2, whereas in sector 1, the net lending borrowing coming from the financial account is 3. So we have a discrepancy of -1. Now, one thing that you should start looking at here before you decide now, how you're going to, make sure whether it's 0, whether you're going to have some kind of tolerance, etc. 2 things you have to remember. 1, you have to be very, very transparent with your users, what you're going to allow and disallow. And second, what you should be always looking at is the signs. So in the current and capital account, here we had a positive, which meant that the savings was greater than the uses. And we saw the same thing on the financial accounts. We had more net acquisition of assets than we did liabilities. What would happen if on the financial accounts, instead of having the 3 in sector 1, we had a -3? Would that change your perspective? These are things that I just want you to start thinking about. I mean, and these things you're going to need to discuss, amongst yourselves, okay? But those are the things that you're going to have to watch for. And now this is, in this example here, it's static. I'm just showing you, for 1 quarter or for 1 year, right? You should also then see what's happening through time, okay? And seeing whether, the discrepancy is always the same sign. Is it flipping back and forth, etc.? Okay, just things that you have to start thinking about when you're putting this together. All right. Okay. Is there any questions for here, or can we carry on? Please go ahead. Yeah.
Emmanuel, thank you very much. It is an interesting example, but I'd like just to understand this better. We have looked at in terms of the current accounts, we have seen that in the domestic economy on sector 1, we have some -3, right? So we calculated and we have -3. The same happens with financial accounts, but with financial accounts, -3, this will mean, what will it mean? In terms of financial account, what does it mean to have -3 in financial account? How to interpret this correctly? It so happens that we have 3 liabilities less. Our liabilities decreased by 3, or how do I understand this correctly?
Thank you. Sure, I'll go over it again. Let's see if I can go back one. Perfect. So if we'll just take the example of sector 1. So when you look at sector 1, the net lending borrowing is positive. So if you go back, what does that mean? If you go back to your equation, we said sources must equal uses. Sources are, or if you want to say resources, are going to be more or less your savings. Okay. Uses are going to be what you use resources or sources to acquire, either additional capital or to bring down debt, etc. So in this example here, the savings, so there's more sources than uses, right? There's more savings than there is net acquisition of produced and non-produced capital. We're not going to talk about the current transfers and capital transfers for the moment. So there's a positive. So now sector 1, because they have an excess of sources, they are going to be net lenders to the rest of the economy. They didn't have to use all their savings. They can lend to the rest of the economy. So when you look at now from the financial account perspective, you see that the net acquisition of financial assets, which is denoted as NAFA, is greater than the net incurrence of liabilities, which is 14. So they're saying the same story. Okay. So that the question was, and now there's this discrepancy. I mean, you know, in this example here, you might say, yeah, the discrepancy is fine. But, you know, in a lot of cases, this could be very, very large. And we're going to talk about that in a moment. But in this case here, the signs are both above the line and below the line are trending. They're saying the same thing. There's more sources, there's more assets. Okay. So my question was, the discrepancy is very small in this, everything is fine. Now, would your interpretation or whether your behavior or actions change if in sector 1, the current capital account net lending borrowing still stay the same? We have more sources than uses, 2, but instead of having, you know, a net acquisition of financial assets greater than a net incurrence of liabilities, it was reversed. So the liabilities was 17 and the assets was 14. So the net lending borrowing from the financial account was -3. Now that should trigger something. When you look at that, shouldn't that trigger something? What should it trigger?
If we have higher liabilities.
And don't you want Pierre to explain? Why panic, Pierre?
It should trigger panic because it means that when you analyze the non-financial accounts, you would say, we are saving, so we should be lending something to the rest of the world. And when you look at what you're lending to the rest of the world, you would say, no, actually we are not. So there is a clear inconsistency. Exactly. Of course, if both figures are extremely close to 0, you could say, okay, we are, I mean, anyway, broadly, we have a 0. But if you have substantial numbers, it is very worrying and difficult to explain to the users, because you are telling the users, okay, I have part of my accounts that tell me a message, and the other parts, there's the opposite, and the users will say, okay, but then keep your thing for yourself. How can you help me with this?
Exactly. So you see right here, you see the inconsistency. Okay. And Pierre is absolutely right. I mean, this is a fictitious example. So you can say, yeah, come on, there's nothing wrong here. Let's move on. But it was just to illustrate what could happen. Now, if we were able to get, you know, a time series, right? And then we saw huge discrepancies on the financial account, and we're not seeing those huge discrepancies in the savings account, then what does that tell us? So let's say, for example, we take the exact same example that we have here. However, let's say now that the net lending borrowing for sector 2 is 300. And the net lending borrowing in 1 still stays at 2. What could have happened now? So now, I mean, the GDP economists, I could see them running down the hallways. Emmanuel, you're crazy. We didn't get GDP wrong. It's impossible. You made the mistake. Let me see. Really? What did I do wrong? That's what they're going to say. They're going to say, no, GDP can't change like that. No, it's impossible. We can't have an error that big. No. Maybe they got a point, right? Because transactions, remember, you know, in the first day, we said, well, how are we going to make sure that we record transactions correctly? We usually get data from financial statements, and some instruments, because of market valuation, they might change, not due to additions or to subtractions, but to, remember, what did we say? It was one thing that said the causes, which is not, well, there's 2 things that are not transactions. There's flows in the economy, but they're not transactions. Does somebody tell me what they are? What are the two things we said?
Revaluation and other changes in volume.
Yeah, so now, so we have the national accountant screaming at me and saying, Emmanuel, you can't have, your financial assets at 300. You made a big mistake. What should I do? So you tell me, yeah, there could be a revaluation. I should go back and look, okay. The first thing you should be doing is get all your price indicators. Get, for example, stock prices. What happened to interest rates? What happened to exchange rates? All the indicators that are going to indicate there's a change in price, okay? Then you have to go back and say to yourself, well, is it possible that when we actually try to derive the transactions for our equity or debt securities, maybe we made a mistake. Maybe we took the change and thought that it was a transaction, but maybe that some of the change that we saw from the previous quarter could be due to prices. Is that possible? It's possible. So then you should go back and should work out your calculation. What happens if you work back your calculation, you come back to the national account and say, no, we checked, our market valuation, we've picked up the correct revaluations for this sector, you're wrong. You are definitely wrong. Is it possible that the GDP compilers are wrong? What do you think? Can they be that wrong? Well, what do you say?
Why not? Everything depends on collection of data and how well they have built the flows.
Yes, so you're absolutely right that we're going to have to go back and look at this. But from a national account perspective, go ahead, Peter.
No, maybe one point is that the financial flows are usually much more volatile than the non-financial accounts. So, if you're counting mosquitoes, the error you may do is probably smaller than if you're counting elephants. So in the financial accounts, you have huge things up and down, and if you miss one of them, you have a huge impact. And it is possible that there is a recurrent error in the non-financial parts that accumulates over time to something big. Yes. But in principle, you are a bit more suspicious with the financial accounts because of this volatility, not because financial accounts compilers. I know a lot in my colleagues, even at work, financial accounts compilers who feel a bit bad, like, it's always our fault, as if we would be, not as good as the non-financial accounts compilers. But it has nothing to do with that. It's just that you're measuring things that have a completely different volatility and magnitude.
Yeah, that's a good point. But what I will do, though, is that I would also ask my national account compilers, well, did you have a problem when you were, putting together, the data, for the national accounts for that particular quarter? And they could have had a problem. So, for example, on an expenditure based measure, how well did they track household final consumption expenditure? Is it possible? Is it possible that they missed some imports? Overestimated some exports? How well did they capture the gross fixed capital formation? And then the real elephant for them is how well did they measure consumption of fixed capital? But as Pierre says, it's not as volatile as the financial accounts. The financial accounts, unfortunately, I didn't bring a slide with me. You would see every quarter, every year, wild swings. And it's usually due to, revaluations, not to transactions. Go ahead.
Can I ask you something? So if we are talking about quarters, and we see this example, for example, in the first quarter, when you have a really statistical discrepancy between not financial net borrowing from the non-financial and from the financial accounts, maybe that net borrowing will appear the next quarter because of the time lag on the financial account. So in our case, we were sometimes dealing with that issue.
Yeah, no, I agree. There could be many factors that are causing the discrepancy. When you're looking at the time series, what I was trying to get at is that if you see, for example, a consistent bias, so if you always see, like, let's say, for example, for the household sector, that your discrepancy is always, the same sign, that could tell you, well, why are we missing, all these sources? Because that's what it's telling you. It's telling you that in the household sector, every time we produce the sector, now in the current capital account, it's always telling us that we have more sources than uses. And our counterpart on the financial accounts, if they're not saying that, then the question is that there's definitely an inconsistency. But the thing is, you wouldn't expect that the discrepancy should always be the same size, the same sign. That's telling you that there's a bias in one of your data sources. Okay. And it just wants further investigation. Go ahead, Pierre.
Maybe to say that one good tool for that is to cumulate the discrepancy over time. You look at it over 1 year, over 2 years, over 5 years, and then you see whether there is a systematic bias one way or the other, or if not. If not, in a way, you could be reassured saying, okay, I have timing issues always, and yeah, okay, what is not seen, but then you can look if you frequently have a change in sign from one quarter to the next. So the analysis of the time series is very important to get a hint what to do with the discrepancy.
Yeah. Yeah. So in this other example, what we also like to to talk about and make sure that you realize is that, so if the top portion is done by one institution and the bottom portion is done by another institution, whether you're in the same institution, different floors, but in two separate institutions, how are you going to communicate now? I mean, you can scream like in my example, but how are you going to make sure now that you're going to try to work towards a better end? Because in reality, it's not always the financial accounts compilers that are wrong. Yeah, they might have a more difficult, maybe complex tax. It's not always accurate to say that the national accountants always have GDP correctly, because we know there's always revisions to GDP. There's problems to concern. But now what we're going to do, what you have to do is, that there is 5 sectors in the economy with 5 different errors, size, signs, etc. And now what you're going to have to do is you're going to have to start discussing with the counterparty. So in a lot of countries, you take, I want to say given, but usually, the compilers want to respect completely the balance of payments data, international investment position, and the public sector division. You start as a given, you say, well, look, we want to respect those. And the reason why we respect those, especially the government, is you figure that, it's a very reliable data source. It's a very homogeneous, if you will. So it should be a very, very good source for both the current capital account and the financial accounts. There's definitely less differences in the financial accounts when we look at the government statistics. There's some adjustments you have to make in the current capital account, but let's besides those. So it's a good, reliable source, coming steady, maybe not timely, but once it comes, it's good. And then the balance of payments as well, for international comparability, to minimize, the discrepancies and asymmetries between countries, we want to respect the balance of payments data. Okay? So once you have that, should you just take the data and just put it in and say, okay, we got 2, we got to worry about 3 more other sectors. We don't have to worry about now the balance of payments. We don't have to worry about now about the government sector. All we got to worry about now is households, non-financial, and financial. Should you do that? Well, how many of you say we should move on and just tackle the 3 remaining sectors? We all want to go home. So, there's not enough hours in the day. So how many of you would like just to move on? We say, yeah, we trust our colleagues, they've done a good job, we're good to go. So how many say we're just going to concentrate on 3? Put your hand up. Okay, 1. How many of you say 2? How many of you say, well, we're going to respect their data. However, we need to confront their data as well. So before we go home, we have to do some deeper analysis. So we almost have a tie. Well, we have one who's undecided. So the thing is, you should, yes, at the end of the day, we want to respect, the data that's coming from those 2 programs. However, you need to confront that data. Okay, go ahead, Pierre.
I fully agree, but you need to establish beforehand a process by which you can have a dialogue, because
Exactly.
sometimes in the time frame of the compilation, you have to agree, okay, that number comes
Yes.
and cannot be touched again, because otherwise we just don't have agreed number at the end of the process. So it has to be part of a process.
Yeah, agreed. So when we're looking at when we're talking about revisions, and we said, we have to coordinate revisions, Pierre is absolutely right. You also have to coordinate when the data is going to be disseminated. So in my previous employment, the current and capital count basically came out 60 days after the reference quarter, and the financial accounts and balance sheets came out 70 days after the quarter. Now you're going to say, what's 10 days? Well, that 10 days caused me a lot of stress because, as Pierre said, it was frozen. The data was already out in the public. So you were dealing with NLB, NLB 1, whether you liked it or not, it was frozen. Okay, so that's a very, very important point. If you're going to be takers of data, you have to make sure you have a coordinated schedule. So as you can see, there's a lot involved. In addition to putting the data together, there's a lot of other, I would say maybe, I don't know if you want to call them, I would say administrative processes that you have to establish and respect in addition to compiling the estimates. And this happens more so in the financial accounts, because in the financial accounts, you are basically dependent or interdependent of more than just, one sort of like program. You're taking data from everywhere. So you have to be conscious, of that fact. And you have to build in, as Pierre said, processes to make sure that, there's safeguards in the system to avoid some of these errors. Okay. Is there any other question, or because now we have to do the same thing now for the balance sheet? Go ahead, Pierre.
Maybe one thing is that in an ideal world, your numbers cover the complete economy, all instruments, everything. In real life, it can be that that one sector is not well covered, or especially we have this instrument in the accounts, other accounts payable and receivable, which can include a lot of things. And generally, there is little data collection on that. And so it means that the discrepancies you see incorporate actually vast gaps in the data collection.
Yes.
And then I don't know how you would advise to handle it, but it's a bit a challenge, no? What I mean is, it's a different situation if you say, my numbers cover everything, they should match, and so I adjust them as best as I can. Or you say, well, anyway, I know that I'm missing a sector.
Yeah. So that's very good, and that's coming. So that's the second part of the presentation. And there, it's a very good point. You're going to see, an example, not with all the instruments, but you're going to see it with all sectors and with some of the problematic instruments and how we're going to go about this. It's again, it's a fictitious example, but again, it's these things are just meant, to sort of like stir up, some thoughts, and provoke you to start thinking about things that, you should try to take into account when you're putting these things together. Okay. Great. So now we're looking at the balance sheet. And the same identities that we talked about when it comes to transactions apply for the balance sheet. For financial assets by instrument, here it says category for the whole economy must equal liabilities. Okay. Total assets less liabilities equals net worth. And remember, when you see assets, we always are including non-financial. It's the whole thing. It's not just financial. So in this slide here, I was just saying that the same basic principles that you saw before have to be applied to the balance sheet. Now, how are we going to reconcile the opening and closing balance sheets for any given sector? So in this fictitious example, you see the first column has the accounts or the categories. The NFA stands for the same thing before. It's non-financial assets here. The NAFA, is the same as you saw before, is the net acquisition of financial assets. L is, or the NIL is the net incurrence of liabilities, or in this case here, liabilities, we have a discrepancy, and then net worth. So we start, for example, with the opening balance. You had 80 for non-financial assets. You had 70 for financial assets. There was 80 of liabilities, and that gives you a net worth of 70. Okay, the 150 minus 80 gives you 70. And here you have the closing balance. Closing balance in this example was very, very simple. Everything is 100. Now, when you take the change in the balance sheet, you see that non-financial assets have increased by 20. Financial assets have increased by 30. Liabilities as well by 20. So the net worth increased by 30. But then we have to decompose that change in the balance sheet into its constituent parts, what we call here the accumulation accounts. So when we look at the capital and financial account transactions, there was transactions of 10 in non-financial accounts. There was 15 in terms of financial assets. We incurred 10 of liabilities. Where a discrepancy now from the top, where we did the current capital account and the financial account balance of -2. So the net worth was 13. And then in order to square, we're going to assume that there's no volume changes because we know that the change in the balance sheet is 20. We had transactions of 10. The difference between the transactions and the closing balances is going to be the revaluation account in this example. But here again, what you're seeing is that now we have a residual or something unaccounted for the whole economy, which is basically being dragged down from, what we were discussing from before. Right? Good. So now let's see if we can do the compilation example. Just one moment, I'm just gonna get a quick drink of water and then I'll start. All right. Now, I hope you all like Lego when you were kids. I certainly do. I still do. So this is my example. All right. So here is a process. It doesn't necessarily mean it's a process that you have to follow. It's a process because I want to basically illustrate certain things that you should be looking out for when you're actually putting together the whole balance sheet. And here we're just looking at balance sheets. It would have been, we had an example, but unfortunately we needed much more time where we could have gone through transactions, revaluations, volume changes, and then balance sheets. But for now, with this example here, I'm just going to talk about the balance sheet. And it's not all, instruments. So in terms of our categories, for non-financial assets, we have produced and non-produced. For financial assets, we're just taking 4: currency and deposits, debt securities, equity, and other assets. Okay, and in other assets, we're including loans. When it comes to financial liabilities, we have the same 4, and that's going to give us our net worth. Okay, and we're going to assume in this example that we have an enterprise survey. So the example that I'm going to show you, this is for the non-financial corporations. And one thing that I want you to keep in mind, when you're putting together, the financial accounts and balance sheets, there's various ways of approaching it, depending on your data sources. Some countries basically look at instruments. They basically compile instruments, they sum up the instruments, and they get their totals. Some countries have very, very good data for all sectors. So for the household sector, non-financial corporation sector, so they build sector totals. Okay? Some countries have a hybrid approach. They're going to use totals coming from the sectors for certain categories, and they're also going to supplement some of the detail coming from other sources. So from their instruments. So it's a hybrid approach. And this is going to be a hybrid approach. Okay. So in my fictitious economy, they benefit not only from having, a good instrument data for some of the instruments, but they also have good, totals, for some of their sectors, not all the sectors. So for non-financial corporations, they have an enterprise survey. Now, let's just go here. From the enterprise survey, they take the data and they put it directly into their sector. So the enterprise survey gave them, for example, 750 for non-financial assets, 1,150 for financial assets, financial liabilities of 1,700, net worth of 200. You can see here. So the first thing that you have to do as a compiler is you look at this data and you're going to detect and you're going to investigate whether there's any outliers or any series breaks. Again, I'm just showing you a point in time. Usually when you're compiling these things, you look at a time series. I mean, when you look at a number, just a number, you don't know, you can't tell much of it. Yes, we can say that the net worth is 200, the total assets, are 1,900, the financial liabilities of 1,700, but doesn't tell us that. We don't know whether it's growing, whether it's decreasing, what is the percentage change. For example, in some of these instruments, we don't know anything. So usually when you're putting this data together, you have a time series. So through your time series, you'll be able to detect, whether there's some outliers, whether there's some series breaks, okay? And depending on your organization that you work, you might have a separate division that's actually conducting the enterprise survey, and they send the data to the compiler. That's one model, or it could all be done, under one division. I'm not quite sure how you set up, but we're going to assume here that there is a separate body who's responsible for the collection of the survey, the collection, the compilation, and then they pass the results on to the national accountants, financial accountants. So once you've gone through your preliminary analysis, you're going to go back to the provider of the data and you're going to ask them some questions. Okay? You're going to ask them to investigate. So you're going to do some kind, this is your initial data analysis, okay? With the provider, and then you're going to also do some initial data analysis against economic events and theories. Because remember, the power, of the System of National Accounts is its framework. Okay, so you have to be able to go up and down and confront the data throughout the whole system. So, for example, here, when we look at the non-financial assets, if we had the previous period and we could look at the change, then we can go back up and make sure that gross capital formation is showing that transaction, for instance. Okay. The same thing when we're looking at the change in our financial assets, we can go back up and say, well, okay, when we look at, let's say, for example, whether a net lender, net borrower, example. Okay. So you're not working, in a silo here. You have to keep on going up and down the sequence of accounts. And if you do that, then that's going to give you sort of like, the ability to say, yes, this is a reliable estimate. Okay. All right. And of course, sorry, before I go there, before I do all of them, just one thing, you're going to also have to make sure that your business register is up to date. So right now we've got, for this particular point in time, our business register told us, this is, the non-financial corporation. So we don't have a problem, whether, we have any misclassifications, this is proper. Okay. Then we get the data for all the other sectors and we put them all together in our matrix. And you can see here, we have our main sectors. Okay. So this is, again, it's the initial stage. We just loaded the data in here. So the first thing that we're going to do is we're going to see, we have to go back and make sure that our identities, are being respected. So if you look at just the total financial assets for the economy as a whole, right, including non-residents, we have 6,750. And when we look at the financial liabilities, we have 6,550. So, and then when you look at within instrument, currency and deposits, we're not balanced at all. This was the initial stage. We put the data in there, and now you can start seeing the imbalances. Okay, they're throughout. Right? Nothing is square. The only thing right now that we can check off is the non-financial assets, because we confirm that, with the national accountants, we got the right transactions, we incorporate the right revaluations, we're checking those off. But now we have to do the same thing for the financial assets and the financial liabilities. So this is what I was just saying to you. You can just see we have issues. So now let's go back to our non-financial corporations, because this came, from the enterprise survey. And we were saying, well, is it possible that it's the non-financial corporation data that we put in there that's causing all these discrepancies in our system? It could be. So one thing that we quickly look at, we know that in order for non-financial corporations to increase their capital stock, if they don't have internal financing, i.e., they don't have sufficient gross operating surpluses, they're going to need to borrow money, right? Now, they could borrow externally, or they could issue debt securities or equity. So one thing that you could look is you can see how the growth or the level of debt securities and equities is comparing to your non-financial assets. Just making sure that things look, they're lining up the way they should. And you can do other tests as well. Okay. And one thing, so let's go back. So one thing that's important here is that this data came from an enterprise survey. And we know that there's certain limitations with the enterprise survey. But one thing that we're going to respect, though, is that we're going to respect the net worth. Okay? We're going to say that, we think that the survey is giving us a good indication of the net worth of non-financial corporations. Or if you want to say the financial assets, financial liabilities. However, we know that when we get data from financial statements, including an enterprise survey, we don't get the granular detail that we want. Okay? We believe that the aggregate totals are probably accurate. Total assets, total liabilities are probably accurate. So we're saying, that's what we're saying, maybe the net worth is a good indicator. However, within total assets, within total liabilities from the survey, that's what we're going to challenge. Okay? And in this fictitious economy, they were fortunate enough to have a security by security database. Here it's referred to as a debt security database. So our debt security database, So initially from the survey, we got debt securities of 400. But now what we're going to do is, because we have alternate data sources to confront the enterprise survey, that's what we're going to do. And you could do that not only, if you didn't have, let's say, for example, a debt security database, you're going to do that for currency and bank deposits. So you have different information for currency and bank deposit assets, right? If we look at monetary financial statistics, if you look at deposit-taking institutions, the liabilities that they have with non-financial corporations is going to be, should be, the financial assets of non-financial corporations. So you can check that, okay? Similarly, when you look at the financial liabilities, you can do some cross checks with your equity. If you have, good information, on stock markets, you can look at the listed shares, of non-financial corporations and say, okay, does this make sense? Now, equity is, you're gonna have to break it down, because as we saw before, there's 3 components. We have the listed shares, which we'll probably think we can get a good number for, but then we have the other 2 components, the unlisted and the other equity that could cause us problems. So those you have to keep in the back of your mind, that, okay, that could be an area too that's causing us problems. Another area that's causing us problems, as Pierre mentioned, could be this other liabilities. Because especially when it comes to enterprise surveys, it's not that what they've done is wrong, but what they've done is they didn't give us all the detail we wanted to. So they put a lot of stuff, more stuff than we want, in other liabilities, right? So in this case here, both the other assets and other liabilities possibly are including more than trade credits, trade payables. They could also be including, like in my example, which I cheated, I said they include loans as well. Okay. So already that, there's more things in that other category that we don't want. But in this example here, we're going to stick and we're going to say, well, okay, we're going to look at our debt security database. And our debt security database says to us, oh, no. Non-financial corporations for this quarter, we've calculated that it should be 500, not 400. So what are we going to do? We've agreed that our security database, we've put a lot of resources, like my group number 2. We have one source. We want to use that source. So we're going to say, no, we're going to remove the 400 that was reported from the enterprise survey. We're going to put the 500. When we do that, when we just put that number in now, we increase the liabilities of the non-financial corporation. And by increasing the liabilities from 400 to 500, we decrease their net worth. Now we've got an issue. We believe that the 500 is correct, but we also believe that the enterprise probably gave us good data, for net worth. So what are we going to do? You can leave it at this here, but now you basically change your net worth as well. All right? So now we've got to start thinking about it. So what we're going to do, we're going to say, no, we're going to respect our control totals. So we're going to go back. We're going to say, no, we want the 1,700 of financial liabilities. And we want to respect our net worth. But at the same time, we also want to put in our debt securities. So now if we take that decision and we're respecting some totals that we have, we're going to have to make now adjustments somewhere else. And what we're going to say is that, with the survey, we think that we're getting, good, reliable aggregate totals. Perhaps there's problems with the detail, and especially in some of the categories. So that's exactly what we're going to do. If I clicked it or not, is we're going to start now. We're going to start now substituting to make sure that we balance. So what thing we're going to do is we're going to say, well, okay, we think perhaps maybe that 100 that we added from our security database into our debt securities could have been misclassified in other liabilities. And the reason why we're going to make that assumption is because in this category of other liabilities, there's also include loans. So maybe the enterprise made a mistake between loans and debt securities. So what we're going to do is we're going to change the other liability number so we can respect our debt security number. So we're doing that. And we did that. So far, so good for non-financial corporations. But when we did these changes, now we've caused other problems. Right? So we still have a problem with debt securities. We still have a problem with other liabilities, so on and so forth. Our matrix now, you can see, is starting to unravel. So now we're going to have to go back and start looking sector by sector to see where we can make adjustments based on other data that we have, based on our judgment, based on what we think, is going on, given our data sources. We don't want to put in numbers out of the blue because you have to defend these numbers. So if a user comes and asks you, how did you get this total? You want to refer them, say, yes, the net worth of non-financial corporations came from the survey. The detail, no, was changed because we have certain, complementary information, and we replace that complementary information. For households, for example, you might say, well, look, we're really struggling with households. We don't have much data. We have some counterparty data, which we're respecting, and those we respect. But maybe when it comes to, some categories, especially, maybe other liabilities, we're not quite sure what we're doing. So you're going to go through that. And here what we did is that we did the same thing for financial corporations. Through our experience, we know that, when financial corporations provide us data, for debt securities, sometimes they as well, they have some issues, when they're actually putting together their assets for debt securities. So again, we want to sort of respect the liability side of the debt securities and then push it onto the asset side. And that's what we've done. So then finally, once we made all those adjustments, we're going to be respecting our control total, and we've balanced the matrix. So now in this fictitious example, we did it very, very quickly. But again, it was just to show you, once you touch one cell, you start then unraveling the system. Okay? And you're going to have to then try to find an offset. Okay? And this is sometimes where, it's very, very important. If we had also, if I had also the discrepancies here, sometimes the discrepancy helps us. In the sense that, if the discrepancy is telling us that, no, we need to put in, more sources, then for that one particular sector, we can say, oh, maybe we need to push the assets a little bit more than the liabilities. So the conclusion here is that you need to go back and look at all the data that you have available, and you leverage that information when you're putting together, your balance sheet. Now, here, this was very, very simple. It takes time and experience to put this whole matrix together. Okay? And it's not something that, in a couple hours we're going to do and we're going to be able to go home. No, it takes time. It takes time, and then you got to stand back and you got to, say to yourself, well, okay, now that we have this final product, what is the story that we're going to tell our users? And does that story also align with the story that's going to be told by the national accountants, the story that's going to be told by the Minister of Finance, the story that's going to be told by the central bank, etc. Right? Because when people are looking at your data, they're going to say, well, oh, the national account said that household final consumption expenditure, was dramatically increased in this quarter. So then if that's true, then you're hoping to see that in your household sector, that the liabilities increased. Or if the liabilities didn't increase, maybe some financial asset decreased. If that relationship is not proven true, you've done something wrong. So the story here for the financial accountant is you have to really be aware of all the accounts in the sequence, all the other sectors, whether you're responsible for them or not, and use that information to help you formulate and derive, accurate estimates. And at the end of the day, you're going to have, very consistent, comprehensive, and relevant estimates for users to use. And this data is very, very important. It's very, very important, for a lot of your key stakeholders. And it's used in a lot of different analysis, but it's a hard job. Very challenging, but very interesting. All right, and I think I'm going to stop here. And before I open to questions, maybe my colleagues would like to add a couple of things that I missed, or some things that should be emphasized, which I didn't emphasize, or even just your comments. Go ahead, Pierre.
So maybe one thing, if we look at your last slide, maybe it's something you tackle later. You are showing stock data, so positions. Is it not necessary to decide whether one wants to balance the flows, whether you balance the stocks, how you deal with that? Because if you touch everything, it doesn't fit.
Yeah, that's exactly it. So here, this was more simple. We're just concentrating on the stocks. You're absolutely right. That's why I said at the beginning, this example, what it should have been done is also include the transactions. And then because what Pierre is saying, then you see, when I basically added that 100 in debt securities, and what he's pointing out is absolutely correct. He's saying, well, if you touch that, that means you changed, your financial account. Right now, I have 100 of transactions of debts, which has to be added. Right. So when I do that, I'm going to change now the balance in my financial account. And he's absolutely right. But that's why I was saying the discrepancy sometimes helps you, because if the discrepancy for the non-financial sector was telling us that we needed more assets or needed more liabilities, then it helps us. So you cannot do this in isolation. The best way to do it is by looking at all your accumulated accounts and your balance sheet at the same time. So when you're going to be making a change, and if you're more comfortable to using the balance sheet, fine. Once you make the change in the balance sheet, you got to flow it back up into your transactions or to your revaluations. But remember, when it comes to the revaluations, there is indicators. So for example, you can take the previous position, the transactions currently, and then what you can do is you can derive the new revaluation from your indicators. So what I'm trying to say is that there's constraints. You can't just put things in there, because, you don't want to touch one thing or the other. There's a lot of constraints that you have to think about when you're putting together the balance sheet. Okay. So when you create a database, for the financial accounts, you have to, in addition to having your accumulation accounts and your balance sheet, you also should have right next to it all your indicators. And immediately what you do, what I used to do, is that I would calculate now my new revaluations and make sure that it still makes sense with my indicator. I know it's hard to I'm just talking words. If you would see it, you would probably understand a little bit more. But the point that Pierre made is crucial. If you're going to touch the stock, now the question is, you're going to be touching the transactions, or you're going to be touching the revaluations, or you're going to touch the other volume. And all I want to say is that there's constraints. Okay? There's constraints all the way through. There's going to be a constraint on your transactions, because you got to make sure that your discrepancy still looks fine, and it also aligns vertically with the current and capital account. You have constraints if you want to touch the revaluation accounts, because then people are going to say, well, no, if the stock market increased by 5% and you're showing a revaluations, because you can calculate the growth of the revaluations of 10%, something's wrong here. Okay, so you got to take this into account. Please, Pierre.
Maybe to illustrate, I suppose you can do it in different ways. What we do for the compilation of the euro area accounts is we just focus on the flows only, and the stock is the residual. We have then checks on the stock, but what we change is only the flows. So we do it as you just said. We start with the transactions, and there the main constraint is that you want to balance horizontally, but you want to balance vertically. So there is an impact every time on the vertical balancing. So that's the first step to balance the transactions. Then we look at volume changes, where there are few things, but you look a bit what you have and try to make sense out of it and gather information. If somebody tells you, I have a huge volume change here with counterpart in the rest of the world that actually might be in another sector of the economy, but we are not sure, then you try to investigate. And the last step is the revaluations, where there is a lot that you can guess from, indeed, plausible price changes for the quarter. We have trouble because the BOP has foreign exchange changes. And so suddenly you have a very strange revaluation, and the BOP people say, yes, it's because it's foreign currency. But in the domestic data, there's no track. So, but still, generally, you have a good plausibility check on the revaluations. And from there, you get your stocks, and then you can compare stocks with other sources and see whether your final stock also makes sense. So these are the steps that we run, and just to illustrate that process. Maybe if I can make another comment, I should have mentioned it earlier, but there is a report published on the ECB website about how to deal with vertical discrepancies. And maybe we should circulate the link just as a background information. And a final comment that is that if you have a large imbalances, another thing to check is really large transactions. We have seen cases where there's a big merger or a big transaction by governments, and it's booked only in one place, and the counterpart is missed, and this can cause really large. So looking at the numbers, if you have a huge number somewhere, always think there must be a similar huge number somewhere else. And if it is not there, then you have an easy way of improving your accounts.
Thank you, Pierre. So we circulated that. John Verinder provided us that note, and I believe it's circulated. One, just maybe as an anecdote to your large transaction. Canada is a very, very large country, area-wise. Population-wise, it's very, very small. And there's a lot of, I would say, comparisons with the US. So the first thing that users always ask is, if let's say the debt of Canada increases, let's compare it to the US consumer. And I'm not sure in Europe, there's these similar comparisons as well. However, the problem is that Canada is very, very small, and it sleeps with a very, very large elephant. Okay? So what is large for Canada doesn't even hit the radar for the US. So a lot of times when we want to make sure that because when you look at the balance of payments, there's got to be symmetry. They're mirrors, right? And for Canada, their largest trading partner is the US. However, extremely large transactions for Canada don't even make it to the radar for the US. The US is going to say, what? That happened? No. Anything below 10 trillion, we don't know about. But for Canada, it's huge. Right? So, but what Pierre is saying, in the domestic economy, of course, large transactions you have to look at. But when you're doing, country comparisons, take into account the different sizes of the economy. Because what is very, very important for you might not even be, recognized, by your counterpart. Okay. Right. So now, should we turn the floor?
Now, perhaps, and I can also intervention, Emmanuel, because I think you clearly show that compiling financial accounts and balance sheets, you have to be some kind of Superman. That's at least what I get from your picture. And I hope that's not what you think it should be. I started my career at Statistics Netherlands, I think 15, 20 years ago in government finance. And there I was responsible for compiling the financial accounts and balance sheet for the government sector. And well, I think at the start, I was very confused. Okay, how do I get this work done, and what does it imply? What do I have to do? And what I learned that it's also, well, just practically start with the work and learn. And then in the end, you understand what you're doing. Of course, you'll make mistakes in between. But the most important part, and that's also in your talk, is communication. If you want to compile these accounts, you're, well, some kind of spider in the web who has to know everything, has to talk to everybody, and has to, well, coordinate, also has to play a role if other parts of the system do not agree. You could perhaps be some kind of mediator in those discussions. But I think that's also important to realize the work you're doing if you're compiling financial accounts and balance sheets. And well, I fully agree with the remark on one-off events. There you really have to be careful, because those one-off events, if you look at the non-financial accounts, well, often they are that big, but in the financial accounts, they can be huge. I still remember early this year, we in the Netherlands had a case where a Universal transferred their, well, financial structure from one country in Europe to another. And all of a sudden we saw 43 billion euros popping up in the financial accounts and balance sheets. And that was a trigger where we said, okay, now we really have to be careful. How do we record that? How do we record that in the financial accounts and balance sheets? But also, what does it imply for the non-financial accounts? So I take from you that, well, you have to be, well, an expert in communication and negotiation. But then again, I also hope you, well, it's also a fun job to have at a statistical office or a central bank. I think it's one of the most complicated tasks you can get, so you can get a lot of satisfaction from that.
Yeah, thank you very much, Gerard. I fully agree with your comments. I hope I didn't, make this. You don't have to be a Superman. I just, I just want to make sure, and I want just to be aware that, because, we heard in the last couple of days, that, we're having issues, gathering data. And here I was hoping that you understand that data does exist. You can, you can find data by talking to people, by knowing the sequence, and then knowing who to ask to get the data. But I guess, you might have gathered, I'm kind of a data nerd, and I really, really love, the system. So yes, I take it upon myself to know a little bit more than I should, maybe, or maybe I don't know more than I should. I don't know. But I find this very, very fascinating. And but as was mentioned by both Gerard and Pierre, communication is the key. And you don't have to know everything, but it's good to listen to people, to understand what the problem is, and see how you can help, and see how they can help you. Oh, sorry, Pierre, go ahead.
Maybe just another word, trying to also to be a bit reassuring that it sounds a lot of things to be done, but once you organize your process, so it was step by step as you presented, and you define the steps that you're going to follow for establishing your accounts, what you're going to check at each step, what are the final steps you run. And so then you just have to implement, and little by little, with more experience, you improve. So it's not that you need to have everything in mind from the beginning. As long as you get it very well structured and you improve it step by step, it gets better and better over time. And yeah, that's the way, and everybody does it.
So do we have time for questions? Oh, please. So now, please feel free to take your mics and ask any one of us what you think, your thoughts, any additional clarification needed.
Just a quick question or a comment. we have a situation, for example, we have some long series and some ratios related to households or something else, but actually from actual calculation, we feel that numbers are not right. Here says that when we discuss these calculations, we just need to know how to do it right. I just set the number, but in this case, my horizontal calculations change and my vertical calculations change. And in order to come up with the right number, I would need a huge number of iterations just to calculate it right. In this case, what to do? What should be the landmark for me? I need to talk, I need to discuss, to communicate, to look at positions, but when the level of macro regulation requires data on a quarterly basis, and we need to have some estimates, there is no time for communication. And maybe we have some other positions that would allow to balance it quicker. The most difficult process in all this is balancing. How to expedite the balancing, how to make it quicker. We're all limited in time. Statistics is not existing on its own. It is not isolated. It is required at all levels for all users, at macro regulation and all other levels. So this point for me is not very clear. Maybe I don't understand something fully. This is my question.
One more try. So I think what we tried to do, in the last 3 days is present, the whole framework as best we could, maybe with the exception without, for example, the production account in some of the accounts. But we weren't sort of like insisting that you're going to have to deal with all this tomorrow. When you go back to your office, you're going to have to be able to do this. We know that these things here take time. And I think it was said, very, very, accurately and correctly by both Gerard and Pierre, that this takes, some experience. The first time you do it, it's going to take, maybe a little bit more time. But what you have to do from the onset is you have to be very, very well structured, and you're going to have to think of, the baby steps you're going to take. And that's why it's important. We've been talking about in the last couple of days. We don't expect you to do everything tomorrow. You're going to actually look at the data that you have available, and given the data that you have available, you're going to build a certain system. And from that, once you get a little bit more experience, you're going to start slowly expanding. However, no matter whether you have a small framework or whether you have the enlarged framework, the balancing is very, very important. And yes, there is methods. I could have shown you an automated method of how to balance it, but you don't want to use those things. What you want to do is you want to use the data that you have available so you can make, good decisions based on the data that you have. And that's going to take time. It takes time. And the moment you change something, goes off balance. It's understandable. And we realize that. And then you do it again, and then you do it again. Once you've done the process a couple of times, you're going to see certain patterns coming to you, and you'll be able to say, oh, okay, I remember I have to do this now. Oh, I remember in order for me to fix, my discrepancy, I need to touch this and this. So what happens is you start developing, certain, I wouldn't say, certain skills to know which areas you need to look, etc. Okay. So I know at the beginning, like everything, the first time you do something, it's a little bit daunting. There's a lot of unknowns, right? So, but then once you, start tackling the problem, you start building, some confidence, and then, you get better and better at it. The communication is important because you are not the custodian of all the data sources you need, to put together the accounts. And the thing is that some transactions or some entries are very, very complex, and they need a thorough discussion with all, the compilers. So let's say, for example, when you're looking at mergers and acquisitions may impact the government compiler, the balance of payments compiler, the non-financial corporation compiler. The non-financial compiler cannot work in a silo. He needs to discuss with the other two to make sure that you have a consistent, solution, to the problem. So the thing is, yes, we know that, the demands on you, are great. You don't have much time. But I think it's important, what Pierre just said is that you have to go step by step. And one of those steps has to be communication. And the thing is that you could do a lot of this work even before you start compiling the data. So for example, if you like reading business journals or looking at, programs, you start building, news already. So certain things that are coming into your economy. So you start being aware that, oh, okay, so, a non-resident company is planning to sort of like, build a plant in my economy. The newspaper article said that they're planning to inject X amount of money. Oh, okay. That should be foreign direct investment. That means there could be now an institutional unit in my economy. So you gather intelligence, okay? And then when it comes time to compile the data, you have to follow, the sequence that you've set out for yourself. And sometimes, the first time you do it, you might think, well, okay, you might have a wrong sequence, but over time you build better, you build best practices. And, like everything else, I mean, yes, if you give me 3 years, I can probably give you the best estimate ever, but who wants it? Nobody. It's too old, right? Everyone is pushing us to get, much more data, much more quicker. So what that means is that, you have to work smarter, not harder. And that takes a little bit of time, to get that experience. But the thing is that, I mean, I know at the beginning, it's a little bit daunting. You see all these things, but as Gerard said, you take it one step at a time. You're going to make a mistake. You're going to learn from the mistake. You're going to talk to someone. Someone's going to say, hey, next time do this. Oh, thank you. Well, this is how we do it in the balance of payments. Oh, okay, thanks, etc. And by sharing best practices, by communicating, you'll be able to resolve a lot of your problems. And it's going to also help you in your workflow as well. Sorry, I don't know. Go ahead, Pierre.
If I may illustrate with a concrete example that goes very much in the direction of what you're describing. So we compile the quarterly data twice for the euro area. The first, we get the data at T+85 and we publish at T+94. And every time it is a huge challenge. Honestly, I think this timetable was set up by people who didn't know what had to be done in that period. But so this means we have a detailed timetable before on which we agree every day what has to be done, sometimes exactly at which time. We do we check the mergers and acquisitions before. So there is a separate database. So before getting the data, we check if there is no major merger and acquisition to be taken into account. T+85, we get the data. We check the input data that we receive. We then make a first aggregate and look at the imbalances. Then we have a meeting already pre-programmed with the colleagues that produce the source data, especially, and a separate one with the BOP colleagues, because we want to ensure this balance of payments consistency. Then based on actually what we have to do is before even they answer, if they know the answer to our question immediately, then we take into account. If they say, I will look at it for tomorrow, we still make a first balancing, which is on the best of our knowledge. So to answer to your question, at that point in time, you have to balance, you know what you have received, anything, probably, maybe you miss something, but timing is very important. So you just do the best you can. A factor that plays a big role is, that whichever sector is much weaker, so you tend to allocate the imbalance to that sector, or if that sector is less important. Typically, other financial institutions, in our case, is something where we know a lot happens. It's not super important from an analytical perspective, so we tend to use that one if we have no further information. And then if we get better information before finalizing the data, we adjust. We run the final checks, often over the weekend, and then we publish. So just to say, this can be done. We do it every quarter. It's pretty demanding, but if it's well planned, well structured, we are not saying we have the true data. Probably we make mistakes, but the process is organized to do the best possible data in the available in the given time frame.
Okay, thank you, Emmanuel, for the opportunities. Maybe this session is the most difficult session for the past 3 days. I want to ask something about what we have learned about the most of session, that the communication, coordination, and cooperative is most essential parts of the compilation, right? And maybe for your sample for your presentation, like before, I want to emphasize on how we confrontate the data, because this is an essential thing in the part of compilation, right? In your case, that you use a hybrid method for using aggregate data, and then we confront it with the more granular data. Then we find discrepancy, right? As your example, that you can treat the discrepancy and put it on another accounts, that maybe on or other liabilities or else. That what I want to ask is when we should put it on the other liabilities, or we just can separate it on the discrepancies, because maybe we find difficult if you have two source of data that have different values, and you can find discrepancies, and then we don't know which one is most suitable or more represented for the data. I don't know this one is more reliable or this one, but sometimes not only this one is reliable, but next time this one more bigger data, then we don't know which one is more we can trust the data. So the data is essential, right? We maybe we cannot just eliminate one from the others, but we can put it on the other accounts so we can capture the data, right? That so the question is from the confronting the data is where how we can. Do you have any guiding principle when we should treat for the certain data like that? Maybe you can explain. Thank you.
It's a very, very good question. And so, yeah, if you're fortunate enough, which actually is not really a blessing, it's actually, a challenge, is when you have, more than one source describing, the phenomenon that you want to measure. And then the question is that, yes, you're going to have to make a decision whether one is superior than the other, or one, you're going to use one and stick one with the other. What we do in the financial accounts, and then I'm going to give you another concrete example. What we do in the financial accounts, we look at the data that's being compiled or being collected by, the monetary and financial statistics, by the government statistics, etc. And given the data sets that they're collected, we make decisions and we say, well, so for example, when we look at deposit-taking institutions, I'm pretty sure in most economies, we're going to say that, look, this is probably the most reliable data source. And we're going to take that data source, we're going to take the deposit-taking institutions' liabilities, and they're going to be the assets of the corresponding, sectors. Okay, so in essence, you just build a whom to whom when you make that decision, and the reason why you're saying that deposit-taking institutions deposits are superior than, let's say, for example, getting the deposits from the non-financial corporations, or getting the deposits from the government finance statistics, or getting the deposits from households, is because normally, if we're talking about sub-annual estimates, quarterly, the enterprises the data that you're going to have is going to be a sample. It's not going to be as comprehensive as the banking data that you're getting on a quarterly sample, for one. On households, very rarely are you going to be able to get data directly from households to tell you how much, cash, or how much deposits they have, right? For government, maybe government has some pretty good data, Maybe not, right? So by elimination, we determine that, this source is not the, ideal source. However, it's much better than using data from non-financial corporations, households, governments, etc. Okay. What you could do though, in addition though, is that what I would suggest is that you don't forget though that you have data from those other sources. So from time to time, you go back and make sure that the assumption that, deposit-taking institutions' deposits are the most comprehensive estimate still holds true, okay? And, you might find that it's different. Now, in the case where you have competing data sources, and it's, after, you've analyzed the data for the current period, you don't know, like you said, sometimes, this, is more correlated with the variable that you want to measure. Sometimes this one is much more correlated, okay? Then the problem is going to be then what you don't ever want to use this source this quarter and use the other source the other quarter. You never want to do that. You have to be consistent. For the cycle, for the revision cycle, you have to be consistent with one source. I rather see you use the wrong source, but be consistent than using the right source and being inconsistent. I know you might think, what am I saying? But I'll explain. Because we need to be consistent from one quarter to the next. Now, after the cycle, so after, let's say, your revision cycle, I'm not quite sure what your revision cycle is, but let's say, assuming after 4 or 5 years, you do it like I would say, like, a revision, then I would go back and see how well did this indicator track what I wanted to observe versus had I used this one. And then if you find that, okay, maybe the other one is starting to become better, then you make the substitution, but then you have to go back and backcast and make sure you have a consistent time series. Because what you want to avoid is you don't want to create breaks because you're putting in different data sources. Okay. So that's the key. And then, there's certain guidelines, I think, from compilers' experiences and from country experiences, you can talk to them and they will tell you, usually when it comes to, certain instruments, we usually go either from the debtor side or from the creditor side. Okay. So when it comes to, let's say, for example, household indebtedness, we usually take the creditor's assets as being good representations of household liabilities. And the same thing when it comes with debt securities. You're going to argue with, no, if we have a security by security database and we're actually, tracking the issuer, you're going to probably say you're going to go and we're going to use that and so on and so forth. So again, it depends on your data. But if you have two competing sources, then I would suggest that, you choose one, or if you want, then create some kind of composite. But go ahead, Pierre, if you want to add.
Well, in our case, we do exactly what you say. So we prioritize the source. However, once you have the discrepancy, so you say you have the imbalance for given, let's say, so typically we have that for securities where we have the source data from the securities database that may contradict the data from the source. And there, we tend to minimize the changes. If the data are balanced like that, we are happy, we don't touch. So because we think we don't have that much information unless we have a clear reason to say. Sometimes we really know, sometimes we hear there is a mistake, you have to correct, then we correct, and then we have to find a balancing entry. But other than that, if the data are balanced, we just say miracle, happy, we leave that as it is. If the data are not balanced, then it can be that your alternative source would solve the imbalance. In that case, we try to know from the source data if it's possible to quickly identify the reason for the difference, but to be honest, very often it's not possible in the time frame. And then in a number of cases, we say, okay, we give priority to the alternative source because it solves our imbalance. And so it's better to do this rather than correct something else on which we have absolutely no clue whether it's right or wrong. It's one of the possible approaches. Sometimes, of course, you do it different because you know that another sector is weaker and you don't mind. But it's one possible way of dealing with these different sources when they are competing.
You know, the thing is, well, I think right now, do we have time to continue this conversation or we're done? 1 minute. So for 1 minute, and I'm going to stop then. I was going to say thank you. I hope you enjoyed our morning session. If you have more questions, please, you know, and you know we didn't have enough time or you're too shy, just please, you know, send us an email and we'll try to address. And as you can see here in, you know, in the conversation that we just had really quickly, you know, there was a lot of, I would say, you know, agreement amongst us, but there's also differences. So, and that's what you're going to find, you know, when you're compiling the estimates, okay? There's going to be differences and you're going to have to sometimes compromise, okay? But please, you know, communication, coordination, and everything's going to go well. So again, thank you very much. I think now it's a very well-deserved coffee break. And yeah, please enjoy your coffee.
Institutional cooperation. So Örn, the floor is yours. Oh, I think it's in place.
All right, I think everybody is back. Thank you, Gerard, and thank you, Emmanuel, for your previous presentation. It was an excellent presentation, and really, I'm going to be now showing you how we do it in Iceland, and it's very, yeah. It's, I don't know if it's best practice, but it's our practice at least. So hopefully you can take something with you from this. All right, I'll talk a little bit first in more detail around the MOU with the central bank. Unfortunately, we don't have it published anywhere. I couldn't find it published at least, but I'll show you some excerpts that you can base yours upon. And then I'll talk about in more detail about the cooperation on balancing and Site 2 classification. This is probably the most interesting stuff. And some lessons maybe to be drawn from our experience. So these are direct excerpts from the first MOU in 2010. So the aim of the arrangement is to avoid duplication of statistical work in the financial accounts and to promote high quality and consistent statistics for the use of policymakers, the general public, and international institutions. I think this is straightforward, and it's similar to what I saw in the Dutch one and probably others. The purpose is also to set out respective areas of responsibility for developing the accounts and related statistics, and to provide a framework for exchange and reproduction of data between the two institutions. This is very important, actually. So there, the accounts will be prepared according to ESA guidelines and will include details on necessary instruments and sub-instruments, so on. They will be compiled using specific questionnaires and templates provided by Eurostat and OECD. So if you're wondering where to start and how to frame your memorandum of understanding, this is maybe one way to do it. Focus just around the templates that you need to deliver to Eurostat, IMF, OECD. We found this to be a very good way, I think. And here it is entailed that the central bank will compile the accounts for financial corporations and the rest of the world. and Statistics Iceland will compile the other sectors and metadata for the same. And we will have the primary responsibility of answering queries and providing feedback regarding the financial accounts and related statistics. More on data sharing. There was a timeline for transmission of data between institutions in the first edition, but omitted in the second edition. Instead, we added the deadlines for publications, and this worked a little bit better. But I think, but I'm still probably I'll add a timeline for transmission of data between the institutions again, back into the new one, or I'll ask for that to be included actually, to make the cooperation maybe a bit, have a stricter form about it, and it's important to outline data sharing between the institutions, also around the legal framework. As Pierre mentioned, can be maybe a little bit tricky in sharing data. So we are on this journey towards a better completion rate of the accounts, and it's nice to hear that. I think everybody is on the same journey. And we're all talking about the same things. So when I came to the Statistics Iceland maybe 4 years ago, this is one of the things that I improved upon, initiating regular working meetings to evaluate the results and compare data with the central bank before publishing the results. Previously, there was a lot of emails going back and forth, but really physical meetings, putting things on the table and discussing it really helped balancing the accounts, in my opinion. I mean, it was a really good step. So there, data is summarized by sector, instruments, counterparties. The accounts undergo a balancing procedure, and here I'm talking about then a horizontal balancing mostly with the central bank, where we balance them according to source ranking, nature of the data also, and the accounts are reconciled between sectors and instruments while maintaining the stock flow principle. We are still, we have ways to go in vertical reconciliation a bit still. And in our experience, many discrepancies in this horizontal balancing are traced back to differences in sector classification, really. So it's important to have a good look at that. That if you're compiling these accounts in, you know, 2 silos, that you have the same sectors, you know, sector classification for both the central bank and statistics office. The approach for balancing initially was done just separately on instrument basis, to balance one instrument, the next one, and so on, using the source ranking. But now we changed it a bit for a more holistic approach, looking at all sectors and key totals. We start from the stock positions. You were talking about starting from the flow. We are, and I think I'll have a look at that when I come back. Actually, it's yeah, we'll have to decide which way. In our case, the stock positions, the stock data is much more reliable, actually. So that is why we are starting there. But of course, both ways are possible. And we have this source ranking. This is something that I inherited when starting, but I quickly realized that it's maybe another good thing to have it completely fixed and by sectors. It's always evolving. The data quality is always evolving, so you have to adjust to that. And now we have this ranking of sources, but for specific instruments and specific sectors, sector pairs. It varies for each pair. As you said, the security database maybe is better for that instrument, while when you are looking at maybe household debt, then you take the deposit taking corporations counterparty data. And we look at of course we have some benchmarks, so the international investment position to maintain that agreement there with the financial accounts and the IAP, and also we look at pension funds in the pension fund sector in Iceland, because it's such an important sector. I mean, it's they are huge in Icelandic well, in Iceland in general, they're the biggest players in the financial markets in Iceland. So and there are some household debt also has to be monitored very specifically, and so based on that we have these discussions and these working meetings where we try to balance everything out from the stock positions, and then the flows have to follow to maintain the balance. And while we do this, then of course there appear some vertical discrepancies, and we are this is the next step really that we are looking at now, to trying to start to tackle those. When you're doing your source ranking, of course, it's important to keep in mind the nature and context of the data source, especially when we're using registry-based data. The purpose of the data collection was not necessarily the same, and you have to, keep this in mind when constructing your, of course, your source ranking. And yeah, maybe I'll add we do this. So internally we are compiling this on a whom-to-whom basis. So we have always these two numbers, actually, the source data or counterparty that we are looking at. So in this, keep that in mind. That's what I'm referring to in my discussion. Underlying all of this is the sector classification, and I'm always realizing more and more how important this is. The statistics institution is responsible for the sector classification officially. For this, there's a lot of there's a need for expert knowledge and know-how to maintain this, and a lot of work goes into this, or needs to go into this for getting it right. We have some algorithms based on the Icelandic NACE for the majority of units, but special attention is required for the delineation of the government sector when some units are inside or outside S13. Really, that requires a lot of work. You need to look at government control, And it's not really possible to use algorithms to do this. It's very difficult to do that. So a lot of manual work goes into that. For the financial sector, then there's cooperation between the institutions. We just make sure that we're not double counting anything or omitting in the S12. I mentioned here that we, in the past, we had a big benchmark revision in 2020 where we reclassified a lot of stuff into the government sector, actually, and for maybe clarifications on things we were not maybe 100% sure. We were pretty sure, but really for the most difficult cases, we asked Eurostat for official recommendations on really important borderline cases, and this has maybe been a very good resource for Iceland to be able to do this. I was just like to mention this to you. So a couple of lessons learned, maybe. The memorandum of understanding is a crucial starting point, really, for the framework and the compilation. It's very important to cultivate the cooperation continuously. And a dialogue is needed on a higher level, not just only the expert level. This is an important point. In our case, there's an increasing need for common sector classification register. We have heard some requests on this. We're thinking maybe an open register for data providers is a good would maybe be a good idea. We're not completely sure right now. We have the database is just within Statistics Iceland, so it's a bit difficult. We are wondering whether we can just open it for everybody or only for certain data providers or institutions, or maybe do it in steps. But just so that everybody's on the same side with sector classification, as I previously said, most discrepancies come from that in my experience. Some challenges for us. We will really have to improve, in my opinion, the access to each other's database. It was really a pleasure to be able to go through the Dutch MOU for my case. It really helped me a lot. We always want to improve the technical environment and float statistics and vertical consistency. Now, this is something we're looking into now because, okay, we have gotten this balancing from the stock positions in we have it down quite well now. So now we'll have to tackle this, and of course, quarterly accounts. I found an old slide from a working group on financial accounts since 2008. Maybe I'll just put it in for fun. Maybe you recognize the challenges there. This is some old challenges. Old and some maybe current still. I just wanted to include it there. So this was sort of my last slide. Now time for questions.
Okay, thank you very much, Orm. I think this presentation clearly and well demonstrates and illustrates how the process of compiling the financial accounts is indeed not something to be accomplished in 1 year.
No,
but it takes some time, and I think it nicely shows all we have been discussing over the past few days. But let's see if there are any questions from the floor for you. Nobody?
It was a good, yes.
Thanks a lot. Very interesting presentation.
Maybe one question when you speak of source ranking.
Uh-huh.
One thing that maybe we have not highlighted so much today is there are data which maybe users don't expect compilers to touch. For example, in our case, government debt is validated, so is treated as a special case, and we would never adjust that government debt in the balancing process, because the users would say, well, these data don't fit with the official government figures. So whether, you know, on top of the ranking of sources, there could be also some sensitivity.
Yes, this consideration. Or maybe you noticed that the government was on top. So I don't touch that at all in balancing. Indeed, and that is indeed the reason. Also, you consider that then maybe the most reliable source in terms of in financial accounts. You say, okay, I got the government debt here. Great.
Yes,
I have to adjust other.
Indeed. And maybe on the vertical discrepancies, one of the recommendations of this report, that is the John Eurostat ECB report on vertical discrepancies, is that in some cases it's good to look at the horizontal and vertical imbalances together.
Yes.
So that you see that you're missing a negative entry, and you have one sector that has a big negative imbalance. You say, well, better to correct that sector, because if I correct another one, then I will have more vertical imbalances, and I will have to touch many more things blindly. So to minimize so this might be relevant when you look at those ones as a next step.
My takeaway from this event is exactly that, to take that into the balancing procedure, and maybe earlier in the compiling procedure as well.
And maybe a last point on so you were mentioning the need for common register. I think so. One big discussion in Europe has been about allocating a standard identification number to entities, because then you can tell reporting banks, okay, you find the number, you report the number, and then there is a database somewhere that allows to have a very consistent allocation, because it's sometimes very difficult to get reporting banks to look at also think of whether an entity is part of government or not. In the counterpart, you make a loan to somebody, and you're told, okay, when you report the loan, you have to tell me if it's a loan to government or a loan to a non-financial corporation. And so, in Europe, a lot of talks have taken place about these identification numbers. And well, I don't know how feasible it is in every country, but it might be good to have in mind. Maybe it, rather than first try to explain all the rules for classifying the entities to the reporting entities, maybe to set up some numbering system might help to go through, and then you allocate the sector in a more consistent way.
Yeah, exactly. But that places a little bit, maybe I don't know if it's a heavier burden or not on the data provider to provide just more granular data, like on each individual unit, than data in the millions, or.
It's a very interesting debate which we have with the US compilers from the Fed, because they told us that so a lot of reporting in the US was still done on paper, and that the negotiation with the reporting entities was a lot based on the number of lines that they had to report. And we said our experience in setting up securities holding statistics was that the reporting agents didn't care. We are at a time of computers, so they didn't care to report many lines. So security by security information in that case, or very detailed, as long as they had no treatment to make. What is complicated for them is to start implementing rules. And the risk you have is the more complicated, the less they do it, and they send you rubbish data thinking, okay, your problem. So
that is
I would say it's a bit of a personal judgment, but from this experience, my impression and the feedback that was obtained on these discussions was really reporting entities prefer to give you raw information, even more detailed, as long as you protect, of course, the data properly, rather than have to make more treatments. And it's also in the benefit of the compilers.
I just like to, definitely compliment on that. That's what we found as well when I was doing work with Statistics Canada. Respondents want you just basically to ask everything because their compilation systems are completely different from, our aggregates. So what they would like to do is just give you a dump, and then you can make, any kind of, summation that you like. It's a lot easier. Yeah, go ahead. Sure.
No, thanks. Good point.
In the back.
Any questions? Yeah.
It's the following question. The point is that it is clear that one of the reliable statistics will be the banking statistics as such, but as we mentioned in the beginning, the classification of the categories according to the banking statistics will be different from the aggregates categories which were discussed in financial accounts. I would like just to clarify for myself, do we do it correctly? At the moment, as I mentioned in the previous session, we compiled the report which is called FISIM. FISIM is the report which is calculating the issues related to the interest rates on deposits and loans received by financial corporations. So then, for this number, we adjust all the GDP of the country. When we conducted these classifications, we used, once again, our chart of accounts, 23 values in the account, and we spread it in a way that I have this account of 14 to 108. This meant on 5 key categories that these are deposits of the individuals as such. These deposits of individuals were attributed to households. Also, we attributed non-incorporated companies. This is individual entrepreneurs based on the account numbers. And we used this approach when we developed the primary accounts. So we can just take it from the balance sheets. The banks can see it. If we go deeper into transactions, we can have some additional sub-accounts. But from this basic 5 values, we can already have some breakdown by the sectors. Is it possible to do this for compiling our financial accounts, or are there some other approaches which you would recommend to us?
Yeah, I'm not really sure. I have an idea.
Yeah, so maybe we just need one additional clarification. So you want to know whether your calculation of FISM is correct, the way you're doing it, or whether your approach is a good approach. Yeah, that's why we just need a little bit of clarification. Yeah.
My point was I wanted just to draw the parallel. When we talk about breakdown by sectors, we say household sector, non-financial corporation sector, financial corporation sector. When we broke down by the sectors, we just took our balance sheet, 23 values of the balance sheet. We compile our balance sheets according to international standards. From these 23 values, the first 5 values demonstrate the categories of users of a financial service. And based on these values, we just broke them down into big sectors. The households, the non-commercial institutions serving households, the non-financial corporations, the financial corporations. Can we use the same approach for the countries they do not yet compile financial accounts? Can we use the balance sheets of financial corporations? Because the balance sheets of financial corporations already use international financial reporting standards. Or do we need some additional reports and some additional approaches? Was I able to explain what I want?
I find it very clear. So what you're asking for is that whether you can use the banking schedules to the way they sectorize, the loans and deposits, whether you can use that in terms for the financial accounts. And the question that you're going to have to ask yourself is, how do they actually classify households, self-employment, non-financial corporations, financial corporations, non-residents? And I'll give you an example. So usually, the banks have a good indication of the account holder, whether it's an individual, whether it's a business. Where the lines sometimes get blurred is that, let's say, for example, you have a state-owned business Are they going to treat that as part of government, or are they going to treat that as part of non-financial corporations? Because in the system of national accounts, we know that state-owned businesses, even though they are controlled and owned by government, are part of non-financial corporations. That's one of the things you have to ask. The second thing you have to ask, you might have some, grayness, if you will, or ambiguity when it comes to some, activities. But generally, that breakdown, that's what the breakdown that we use. I mean, when it comes to the schedules, we're going to try our best. However, we've noticed that when it comes to certain types of, let's say, for example, loans or some deposits, there is a little bit of gray categories when it comes to, for example, government, non-financial corporations, because they don't know, whether because the government owns or guarantees whether it should be part of government or whether it should be part of, the corporate sector. So that's where you might run into a problem, and that's where you want to ask for more disaggregation. Another problem that you face with bank schedules is, where do they classify nonprofit institutes serving households? So are they going to be part of business? Are they going to be part of households? That's another question that you need to ask your respondent. Where would they classify nonprofit institutes serving households? Sometimes, for example, they might put them into households. Sometimes they'll put it into businesses, non-financial corporations. So again, nonprofit institutes serve households, corporations, and businesses. But I'm talking about, let's say, for example, the ones that serve households, you're going to find that sometimes the financial institutions have problems, sector to them properly. But I would say generally, their classification, apart from a couple of peculiarities or intricacies, is pretty good. Where you could get problems is that if you ask them to break down non-financial corporations between, like, let's say, certain activities, then they're going to have problems with that, because they don't use, for example, the ICIP code. So that's where you might get problems. But if you're asking broad groups of sectors, where I can see them having difficulties is the ones I mentioned. I don't know if you want to.
No, I fully agree. Just to supplement with the fact that the discrepancies that you will observe in your resulting data may also guide you. For example, in our case, we have the data from government, and if they are very different, for example, from what the MFIs tell us that they have received from government, then this is a hint that something is wrong and we have to reallocate. And maybe interesting to know, what we do is we keep the total, for example, the total deposits received by MFIs, we would not change, but we would assume that the MFIs must have made a confusion between government entities and non-financial corporations, and we would switch the counterparts if there is a large discrepancy. So, but yeah, the idea is simply is to say, on top of all these checks that you have to do with your reporting agents, the data may also guide you to see whether everything looks consistent or there might be some issues.
If I could add maybe also, in my years, if you're not compiling financial accounts at all, but you have this deposits and loans and sectorized also for FISM calculation, I think it's a good starting point. If you don't have anything, yes, of course, and it's a great starting point for these instruments.
Just one small point also for the sectoring, something we've experienced when we talked with countries. I don't know your case. Often national accountants there is quite large informal sector. Often sometimes national accountants may tend to reclassify some unincorporated enterprises to the corporation sector in countries. So that may make you the split households, non-financial corporations. You just have to see on the national account side, will they make any large reclassifications?
I just meant that in principle, when we look at our balance sheets and monetary statistics, we can clearly define for ourselves how to transfer all the key sectors. This was our basis when we started all these processes. Our process was initiated, and moreover, we would like to have some experimental calculation. But frankly, I'm cautious. I'm just saying you're pointing towards the central bank. And I represent central bank in this working group. And I'm always joking, you're always pointing towards the central bank, and the central bank can break down financial corporations, but we need to do more calculations and more adjustments to see the picture more or less normally. So this is why I'm asking so many questions, and so the questions which are practical, because where they have some practical side that we need to resolve. Yes, Tihamira, you're right. There are different intricacies, and in your answers, I have heard many useful things, which I will apply. And I have a counter question for you. Emmanuel and Pierre rightly mentioned that we need to look at category of the enterprises. We have classifiers. They are developed. Our classifiers work in according to NICE, but we have different question. For example, in our banking system, we have 5 commercial banks and 4 states commercial banks. If we look at the charters of states commercial banks, it is written that according to their liabilities, the state is not responsible. So where do I attribute these banks? Should they be part of government, or should they be part of financial corporations? Just a small and practical example. How would you resolve this issue?
Well, so the question would be, well, these state banks, do they basically offer their products at, economically significant prices? That's what you have to ask. Or so if they do, then, they could be still part of the, they could be owned or controlled by government, but we should put them in the financial corporation sector. What they're called, financial government business enterprises, or I don't know what the international term is, or financial state-owned enterprises. If they're actually, providing services, goods and services, at economic significant prices. But they're not, but if they're not, then, then the question is that, are they basically just a special arm of the government, and they're only servicing a certain part of the clientele? So in other words, are the products that they're offering, the interest rates, are they competitive? And anyone can go and apply and get services from them, or are they sort of like segmented to a specific market because the government wants to enhance some kind of housing affordability, or some kind of financial assistance? So, but if it's the intention is for them to make a surplus, if you will, to me, I would, as a first glance, without reading all the details, I would say they're a financial corporation. Sure, Pierre.
Yes, well, maybe to say the starting point is really the SNA 2008, to look there the rules. And so in Europe, we have a more detailed version, which is the ESA 2010, which of course is especially conceived for European purposes, but still might be a guide if you feel that the SNA is not precise enough. So I would advise, I think there is a decision tree on the criteria, and very much in line with what Emmanuel described, to make a decision on the classification, whether it's government or not. So I would advise to look into that as a guide.
Yeah, I was planning to add the same suggestion. What you also could do is, in Europe, we of course have the EDP, the excessive deficit procedure, and that's a procedure where Eurostat also writes a lot of guidance for the member states on classification of government units. And there are also decision trees and, well, more guidance on when is government at risk and should it be attributed to the government sector, for example. And that's the manual on government debt and deficits. I think the latest version is of 2018, and a new version will be published by the end of this year. So we can provide a link, but that's what can also be very helpful, because basically the manual government debt and deficit is also, well, a further explanation of the SNA and of the ESA rules. So with that, I'm going to close this part of the session. So thanks again, Örn. And now has come the time that we again put all the theory and concepts into practice. So we designed an exercise for you. We're going to blend the exercise with lunch. Also giving, well, unless we want to finish at 6 o'clock this evening, but I'm not sure we want to do that. And also to help us send us questions you still might have, just to send them to us by mail. We got a few questions, so we'll address those as first. But please also, if you still have questions, I also noticed that in the lunch break, a lot of us here at the table were approached individually by you with some very good questions, which could also be very interesting to the rest of the participants of this workshop. So please don't be shy, ask that question also here. I think we start with the 4 questions I have. Yeah, I'm prepared. We start with the 4 questions which were sent in by mail. And to start with the first question, and that's specifically addressed, I think, to Pierre. Let me read it out. You received the financial accounts from European Union members. And as far as I know, at least each country should divide S2 sector into S2 EU members and S2 rest of the world countries, thus compiling financial accounts for the euro area. The imbalances for this S2 EU members logically could appear. In case, what are the procedures and how does the ECB identify and eliminate these imbalances? And should an EU member in this case be to revise all its financial accounts data and to republish them again? In other words, how does the ECB ensure consistency between countries' data? A very good question. Yeah.
Thank you. It's a bit a complicated process that is very specific to the compilation of the euro area aggregate. So maybe to reassure those who might not follow all the details, it's a rather specific thing that in principle does not affect the compilation of the country data, except for euro area countries that have to provide the split. But even for them, they just have to make the split, and the rest is essentially dealt with at the level of ECB compilers. So what happens is, imagine you have a loan from let's say a German bank to a non-financial corporation in Spain. So in the German financial accounts, you will have a loan, let's say 100 euros. You will have a loan, so an asset of 100 euros in the banking sector, and the corresponding liability is an S2, rest of the world liability. And conversely, Spain may record that they have an S11 liability for 100 with counterpart in S2 from the Spanish perspective. So rest of the world is not Spain. That balances in the national financial accounts the entry. And so the problem we have, but it's only for the euro area compilation, for the country data, that's it. In the euro area, what we would like to show is a loan from sector S, resident sector S1 to 2 to resident sector S11. So sorry to bother you with the codes, but so resident sector banks to a non-financial corporation. And if we just sum up the entries, we will have entries in the rest of the world reported by Germany and Spain that we want to get rid of because they are not meaningful at the level of the euro area. The level of the euro area, it is an internal transaction. It is not a cross-border. So what we do is that we request the euro area countries to report an additional breakdown where they would identify if the transaction was vis-a-vis another euro area country or vis-a-vis the rest of the world, so outside the euro area. And second part of the question is, we could have asymmetries, yes, because indeed it's possible that the loan was recorded on the side of Germany, but for whatever reason it was not recorded in Spain or for a different amount, and then we would see some asymmetry in the euro area accounts, which would materialize by an imbalance for the loan instrument. In this case, you would have an imbalance. And actually, so we do two things. On the one hand, the BOP colleagues have a process to check asymmetries of the national balance of payments data. So between the balances between euro area countries are checked and discussed across BOP compilers to try to identify, it's of course only useful for the largest transactions, but it helps to close some, to solve some errors here or there. And for the rest, well, then we see the imbalance. And if there is when compiling the euro area accounts, and if there are really specifically large amounts here or there, then we try to ask the compilers if they know what country, in this case, we would contact Germany and say, you have this big amount. Well, then it would not be 100 million, but maybe billion. And we would call them and say, do you know what loan is this? So who got it? And if they say, okay, it's Spain, then we would try to know, to check that this is covered on the other side. And for small amounts, most probably this is we just see the net effect in the imbalance, and then we balance on the best on the basis of the best knowledge we have. I hope this clarifies, but otherwise, let me know.
Okay, thank you, Pierre. And like you indeed say, in Europe, we have also what I think it's called the asymmetries resolution mechanism, where once we see an asymmetry between different countries, the countries are called, they communicate, they coordinate, and in the end, hopefully decide, well, unanimously what the booking should be. So that's the way it should work. Let me then go to the second question: how the reconciliation procedures between the non-financial accounts and the financial accounts are organized in practice? Are there, for example, pre-established indicators, procedures, or steps to do it? Or more specifically, from which end this activity could be started? So I guess that's implied, should you start it from the non-financial accounts or for the financial accounts? Who in the panel would like to kick us off?
I can mainly speak of what we do for the computation of the euro area aggregates. As I explained already briefly yesterday, so Eurostat compiles the non-financial accounts, and we take the net lending, net borrowing, so this B9 aggregate as given, and then we compile in parallel, but then we can adjust the financial accounts, and there we apply thresholds. So depending on the sector, for example, for the sector, the financial sector, we expect that the difference should be very, very low. But for some other sectors, we tolerate some larger discrepancies. And yes, that's the way we do it.
Yeah, another good question. I think we've talked about this. I think from my perspective, it's country specific. So I think we had some really good responses yesterday, because some of you attempted to answer that question. So you have to look at a lot of factors like the legal arrangements in your country, the resources that are available either at the central bank or at the NSO. Basically, who's responsible for the data, the jurisdiction of the data. Sometimes, the NSO has much more regulatory powers to collect information, than the central bank, etc. So I think in the end, it's going to come down to countries, specificities in the environment, that these institutions work within the country, and it's going to end up at the end, depending on the Minister of Finance, who they want to actually do what. Because at the end of the day, basically these are estimates that are going to be used, by some of the power users in your economy, and they're going to ultimately, make the decision by applying or providing resources to one or the other institution. And once that has been established, I think again, the theme, for this workshop is, communication, cooperation, and collaboration. So once the decision has been decided who does what, then the next stage is going to be, well, how are you going to ensure that you have consistent, coherent estimates, and which is going to require some mechanisms to be able to communicate and to share information, but at the same time respecting confidentiality, directives of each institution. That's what I see.
Thank you, Emmanuel. And I truly hope that from this workshop, you'll also take that, well, discrepancies are part of the game. So statistical discrepancies, and well, try to solve them as best as you can, but well, certainly not reduce them to zero unless you have good indications that it should be zero. And it has also been mentioned that there's a task force, a Eurostat ECB task force, who produced a report with also some guidelines on how you, well, what's a proper amount of statistical discrepancy, and what kind of limits can you set to that. And we will, of course, distribute that link to that report. You may also react from the room if you wish, otherwise I just click on to the third question. How often the revisions of compiled data could be done normally? Evidently, at the beginning of publishing, frequent revisions are sometimes obvious, but after 2, 3, or 10 years of data publications, quite often revisions will decrease users' confidence in our data and their usefulness. So how to preserve this balance between quality of the data and the user's confidence and the interest in our data? That is I think, what is the recommended policy for revisions? So perhaps you like to start?
Well, I think it, depends on the setup in each country. I mean, because you're taking all these statistics from different accounts, and they of course have their revisions. So sometimes it's not feasible really to have everything revised at the same time. So you sort of need to make these decisions on a case-by-case basis.
Okay. So it's use your sense if you want to have a, perhaps one of the others, Emmanuel?
Yeah. So, one type of revision policy that you can implement is basically based on, the accessibility of the data or the availability of the data. So if we take, for example, a quarterly program, what's going to usually happen is that in the initial year, you have a certain set of data that you're able to work with. So usually you're going to have your sample surveys at that point, and that's the data that you're going to be integrating, to be able to compile estimates. A year from then, usually what you get is what we call the annual estimates. So that's when the administrative tax data becomes available. Perhaps you might get, much more comprehensive, enterprise data at that point. You might also at that point have certain estimates that are only available annually, like, for example, your gross fixed capital formation, et cetera. So then that's going to create another revision cycle for the previous year. So once you have the annual data, then you go back and you're basically then what you're basically doing is you're benchmarking your initial quarterly estimates now to this annual source. Then you could have a further iteration, for example, depending on when you're able to compile a supply use table. Because see, the supply use table is going to give you the level of gross domestic product, whereas, prior to the supply use, you're going to be able to get very good what we call movements or trends, in your estimates. So what happens once you have your supply use table, which hopefully would be 2 years after the initial quarterly estimates, in ideal cases, then what you do is you go through another iterative process, because the supply use is going to provide you now with a comprehensive benchmark estimate that you want to benchmark your estimates to. Finally, what you're going to do is that when, for example, you update a major methodology, like let's say, for example, you were trying to measure FISM, but you weren't able to allocate FISM by industry. So what happens is that in your production approach, you just had, the intermediate consumption was being offset on the production approach. Once you got better data and you're able now to actually allocate it to activities, you might want to decide and go back, and this will be a special revision, and that's going to be due to a methodological update. And then finally, you're going to try to take another revision when we have updates to the system of national accounts, right? Because as you know, the system of national accounts, is being enhanced. So what you want to do is that you want to be able to have a consistent time series to basically align your accounts with the new manual. And that's what we call, a comprehensive revision that's going to go back in time. But though that revision happens, not that frequently. It should happen, whenever you have the resources and the time, and you're taking a serious look at your statistical system. So that might happen once every 10 years. The key, though, when you actually apply revisions, is that the first thing that you have to do is you have to inform your users. Before you undertake the revision, what you do is you start doing some town halls. You go and you actually present to all your key stakeholders and to the laymen that next year we're going to be undertaking this revision. And these are going to be the areas that we're going to revise. So you're proactively, you're telling them where the revisions are going to lie, generally. Okay, it never happens that way because, sometimes, you get caught by surprise once you open up the Pandora's box. But if you have a good communication strategy and you forewarn, your users, they're ready. And it's very, very important to do this. And the reason why I say that is that there's a lot of entrepreneurs or a lot of businesses that use your data, and their livelihood depends on the data that you produce. And usually what they do is they build their frameworks based on the current structure of your information. So sometimes when you're going to be doing revision, you're going to change the structure. So if you forewarn your users that, this revision is coming up, where the revision is going to take place, and whether the structure of your data might change, at least then they have some lead time to make the adjustments necessary to be able to accommodate, the revision. Okay. But again, then once you undertake the revision and the data is when the data is ready to be published, you always have a methodological note explaining the revisions. And it's good practice to show the pre and the post, and why now the post is better than the pre. And at the same time, you take the opportunity to advise the people that, we might have now another revision somewhere down the line. So to me, that would be, one approach that you can take to revision. Again, transparency is key, communication is key, and, you have to be able to, communicate to users that, these things are happening. And then you don't get the backlash that you think you're going to be getting.
I have an anecdote on that, which is that, so when I started to work at the ECB, I was in balance of payments, and so we started publishing the euro area balance of payments, and the users, so ECB economist department, economic department told us our revisions, we don't want to see revisions. Please minimize this thing. And so the timetable for revision was set up in a way that we would revise only at a very late stage. I don't remember how long it took to then finally revise. But when we revised, because we had waited so long, the revisions were very massive. And then the same users were furious, saying, how come that we learn only now that there are changes? So yeah, just to be aware, there is a bit, of course, if you're a user, the most simple is you give me a number, and that number is the final one forever. And that's they don't have to review their conclusions, but it's not realistic. So you need to set up something realistic based on your sources to reflect more or less the information, the new information. What we do for the Euro area, we revise the complete series starting 99 once a year, and otherwise we revise every quarter, something like 4 years. There is a harmonized European revision practice which is not implemented fully by a lot of countries, but still maybe relevant to be aware, especially for candidate countries. I would say so because the question had something to do with also the very old data. I think for the very old data, it's good to have a real good ground for changing them. So when we revise the data for 99 Q2, if it is just that somebody suddenly had a slightly different idea how to do, or a small improvement in a survey, and then that is retropolated because nobody makes can change the survey 20 years later, it might not be such a good idea to change the data. But if there is a solid ground, I think probably vis-a-vis the users, it's best to be transparent and then to explain. The communication is important, but I think it's feasible only. So when you do, like you have the new national account standards, then you can communicate in detail on the revisions. Otherwise, some compilers write a few lines to their users on the reason for main revisions, which might be a feasible approach. We don't do it currently for the Euro area, but that might be appreciated at least by internal users.
That's that one thing. And another very strong analytical piece that you should be thinking about is revision analysis. So you should keep track of your revisions. So it would be good. What that means is that the first time you were able to, compile an estimate, then you keep track of how it changes through that revision cycle. To see, at the end when you stop and you say, yes, we think we've covered it. Now we can give it to the historians to see, the evolution of that estimate. So revision analysis is very, very important, and you should take a lot of time and looking at why these estimates were revised, because that's going to give you information on how to improve the estimates.
Yes, we have a large database. Every quarter we save the results, and after a couple of years you have this nice database where you can see for each number how it changed over time, if it is very volatile or not, and it's very helpful even for the recent data, because you have a clue whether the very first version is usually can be trusted or is usually completely wrong, or so you can use that to a large extent even for the way you estimate the recent data.
And just as a last point, if I may, Gerard, when it comes to the historical time series or the backcasting of the historical times, or the revision of, let's say, data going back to 20, 30, 40 years, you just want the longest time series possible. So if your institution basically started compiling data, like probably in Stats Netherlands in the 1950s, they expect the time series to be revised all the way back to 1950. And the only word of caution that I'm going to give you is that 99% of the people who are making the revision today were not around 30 years ago, 40 years ago, 20 years ago, 10 years ago. So in other words, you don't know the culture or why, the data was assembled the way it was. So when you're going to change the back year, you better have a very, very good reason of changing it. And be careful, because, there are certain cycles that are in that back period that you're never going to know about, because you never lived them, you never existed in. So if you're going to change the back period data, it better be because you're updating it to align to the system of national accounts. So it's a series that you never had before, because you don't want to rewrite history.
Maybe one last point. I can point out that there was actually a task force on revisions. It's a task force, combined task force from OECD and Eurostat, and they published some guidelines actually, just to point out that there is this. You can see it on the OECD website at least. And there a summary of recommendations for revision policies in general.
Okay, thanks. And we'll, yeah.
On a more general note about revisions, I know it's very difficult also versus the users and people who don't understand revisions. I think more generally, in the SNA update, now there is a guidance notes, which is about taxonomy of revisions will be included. So that will mean also on international level, that will not tell you how to do each revision in financial accounts or whatever, but more how to enhance communication and explaining to users, and also on international level to enhance that notion that revisions are normal part of the process. And these are not necessarily mistakes, so how as they could be perceived from users' perspective. But that also could help. Thanks.
Okay, thank you, panel. And then just to add, I think a lot have said about revisions, and well, I like the notion it's part of life. You will always have revisions of your data. You're never sure once you compile the data, it will never change. That will never happen. You will have new data, new insights, and you have to, but you really have to be careful and think about, okay, but at what point in time am I going to have revisions? And more importantly, what I always say, and what I learned over the years I've been in national accounts, is that what your users want really matters. So if your users can accept that you, well, revise your data every month, please do so. I do not know of any user who wants to change our data every month, but should they wish so, you should see how you can accommodate that. But basically, many users do not have a notion what a revision is. So in that respect, also some kind of education from your side is needed to explain what are revisions, why do we need revisions, and what does that imply. But more importantly, also be predictable with your revisions. So if you have a policy, or you should have a policy, say, well, we do it every 3 years, or we should do it every 5 years. Oh, we're just starting, so we foresee that for the next 5 years, we do it every year. And anything in between is valid. But please talk to your users on that and agree with your users. Okay, what would be the best way forward for us? And then, of course, it can also happen that there will be a, well, incidental revision. So something happens, well, you look at your estimates and you think, oh, this has gone completely wrong. And that's where, well, crisis management comes in. And you really have to think about, okay, when are we going to publish? How are we going to publish? And then even more importantly becomes communication with your users. What has happened? What does it imply for the figures? And in my experience, well, most users can then perfectly understand why you changed the figures. Of course, you shouldn't have an incident every year or every month, then it's an issue, but most users are quite sensible and understand why you revised the data once you have explained it to them. So I hope that answers the third question. Yeah, sure.
So I just want to add one thing, and you should be also transparent with your revision policy. So you should have a document on your website explaining when you're going to take revisions, why you're taking revisions, and you have to be consistent. You can't decide, oh, we can push the revisions to the next quarter. Because remember, there is election cycles that are going to be going around when you have revisions. So in order to protect yourself and the agency's credibility, you have to stick to your revision policy. Okay?
Thanks for that addition, Emmanuel. But let's move to the fourth question. Which methods of data interpolation, extrapolation are recommended in case that the right data are unavailable? Is a linear interpolation, extrapolation are good enough, or is there a need for more sophisticated econometrical models? I find that a very difficult question. I always say the simpler the better, but I'd also like to hear the views of the panel.
Well, indeed, what we do on our side is very simple. So for the so we compile the euro area aggregates twice. We have this short compilation that I described where we get the data at T+85 and we publish at T+94. And then we have the more complete compilation, which is published 3 weeks later. For the first compilation, there are series that are not collected at all. So we have to invent a number, and generally we take So there is a bit of seasonality in some of these quarterly numbers. So we take the figure of the same quarter the previous year, or the average of the corresponding quarter in the last 3 years, but nothing more elaborated than that, keeping in mind that in principle these are the series that should be less important, because the more important are collected from countries or from other sources. So yeah, the reason for that approach is also that we do it only for relatively unimportant series, but we don't have further any more elaborated procedures for nowcasting.
So the fund has developed quite a few tools, on how to basically interpolate and extrapolate data. And usually, the procedures require that you have some kind of indicator that is correlated, with what you want to actually measure. But as Pierre said, the models are very, very simple. We're not talking about very, very sophisticated, econometric models. The models are, no, I wouldn't say simple. Some of them are like ARIMA, like autoregressive integrated moving average models, but again, it's more for the time series element. You need an indicator, and what it will do is that it's just trying to give you, because usually what happens is that you're going to get an estimate, at a periodicity, which is, not the periodicity that you wanted. So you get an annual estimate, and you somehow have to put it quarterly, or vice versa. So there's some techniques that have been developed. The IMF has quite a few documents on that. If you're interested, I could definitely, forward them. The benchmarking processes, splining, etc. But I wouldn't say they're not really sophisticated econometric models.
Okay, thank you, Emmanuel. Hope that answers the questions. I always, I have some smart staff members, and they always try to try new models, new econometric techniques, and then they come to me and they say, okay, I have a new technique. I put in hundreds of time series, and now I can predict GDP. And the first question I always ask them, okay, but if you can predict GDP, you can perhaps also predict other elements of the economy. For example, the stock exchange. So why are you still working for me? And then they are silent, and then said, no, just joking. But to be serious, what I always ask, okay, but how does the model work? And can you explain to me the outcome of the model? So if I see a movement in the outcome, what's your story behind that? What's the economic reality? What's the story? And I think that should always be a test if you go to interpolation and extrapolation. And it's better to explain if it's a very simple model, but notwithstanding, more advanced models can also help. But I certainly not advise to start with the most advanced models. Those were the 4 questions we had in the mail. But of course, the floor is also open for any other questions you might have for the panel. That's it.
Thank you very much. I have a question concerning classification of individual entrepreneurs. What would be your advice? Should we classify them as households or corporation or financial corporations? And could you please elaborate a little bit more on this?
Before we elaborate, I just want to know, from other countries, whether they're experiencing the same similar problem. And maybe it would be a good idea to, get a little bit of a feedback of whether some of the other economies are also having problems when it comes to the, individual entrepreneurs, and how you guys classify them, whether they're part of the household sector, are they part of the quasi-corporation, non-financial or financial corporations? Because it would be interesting to know from your peers and colleagues what they think before we can give you the standard manual response, but I think it would be also important to know what country practices actually are.
As I mentioned before, we don't work with financial accounts, but we work with FISM, and we classify FISM in a way that we take from the balance sheet of the banking sector those loans that are taken by individuals based on account numbers. In our balance sheet, we can separate between individual entrepreneurs, and we transfer them as households because these are non-incorporated companies. They don't behave as commercial entities to the full extent.
We include them in households, these entrepreneurs, individual. But I think if they have a balance sheet data, so we could include them in non-financial corporations.
Maybe as a follow-up, for some of you, would you also look at the size of the unincorporated? I refer to them as unincorporated. I apologize. I have this North American lingo. The non-incorporated entities, do you also look at maybe the size? Maybe if they have, and the size criteria would be what? Employment, revenue, asset. Can you please elaborate a little bit more? Thank you.
The point is that we have the law on support of SMEs, and so there is clear classification of micro enterprises, small and medium enterprises. And when we talk about individual entrepreneurs, here this individual entrepreneur doesn't do the accounting the way the companies do this. They don't have the balance sheet. They have simplified accounting. They have some activity, and in any case, even if they hire staff, the number of hired staff should not be more than 10 people, if I remember this correctly.
We have also some individual enterprises, small enterprises we put in household. They have balance sheets, but they are with very poor data. Very maybe 1.5 pages, very small number of data. They are not detailed, so they are in household for sure. Maybe about number of employees up to 5 or 10. And also we have some units, we call them like, and I don't remember the English word, but paušali. That is so that some level of revenues that they up to that level, under that level, they are put in household, and they are not obliged to submit financial statements to central registers. So also we have very small, little data for them, and other are estimations for them. We have like number of 2,000, 2,500. They are all in a household.
So I think from what we're hearing from the floor, and I guess, the guidance that we get from the system of national accounts, the definition or the recommended classification in the accounts, and I think you're getting a little bit from the floor, but I'm going to ask one more question, is that you need for these unincorporated businesses to be able to provide, financial statements, hopefully a balance sheet, some revenue and expenses, and then they could be included as part of the corporate sector. If they don't have that, it looks like definitely they're going into the household sector. But I guess one other question I would like to have to both Turkmenistan, and I'm sure I can't see your country flag. Oh, okay. But if you can answer as well, what would happen in your countries if, let's say, we had an unincorporated business, an individual proprietor, and he had 30 employees, and he had good revenue, but he basically was not providing, or she was not providing, all the detailed information on your form. So again, it was an employer of 30 or more. They had some revenue. However, they're not disclosing that information or the rest of the information to you. All you know is that they have 30 employees and they have solid sales. Where would they be classified? Would they still be classified as households, or do you might make an exception and say, well, they should maybe go into the corporate sector?
In our case, I think that it happens that some unit or entrepreneurs are bigger, maybe with a number of employees, maybe with revenues, but we don't decide about that. Maybe public tax office decide about that when they not central register. They submit a financial statement in central register, and there maybe they make them to be to a further step to be in non-financial corporations. So central register, or also tax office when they will see all their revenues and also expenditures. We don't decide that because there are different final statements for all of, we have different for non-financial, for financial. Their balance sheets are different with different detailed data. For government also, for household, as I said, it's very small. And for non-profit institutions also, we have another set of these balance sheets. So they are all different, and in central register, they decide about that who will be, and also this unit, I think that I suppose that decide also by activities, organize everything. So
in our case, our entrepreneurs, private entrepreneurs, they have to open their banking account. And before they do that, they have to be registered. Without that, they won't be able to open the account. And this is why they get into the registers. So they cannot be out of that limit. So for the time being, we do not prohibit that.
So you got some additional information now from your colleagues. It looks like if, the tax authority or whoever responsible for the central business register decides to put them in as a corporate entity or quasi-corporation, they will do so because they're able to obtain a little bit more information. But back to your, to your initial question, again, I can just tell you what I experienced, and that was, we more or less, when I was, a compiler, we would follow basically whether they could provide sufficient amount of data for us to be able to, fill some parts of the sequence of accounts. Not necessarily the detailed parts, but we always made that a point that they have to provide at least total assets, total liabilities, and the revenues before they could be considered as a quasi-corporation. Otherwise, regardless of the amount of revenues or the amount of employees that they have under their purview, they would stick as households.
Okay, thank you, Emmanuel, and thank you all for the rich discussion. I think it clearly shows, like what we mentioned before, national characteristics also may require different decisions, which are perfectly okay. And well, coming to back to your question, I said, well, if it's agreed amongst institutions in your country, how do you, what kind of thresholds do you hold before you decide if it's a household or a non-financial corporation? Well, those can be, well, acceptable because it fits your national purposes. Of course, we have to take into account the international standards. That's also what I have to say. But we all know that, well, even though we can be quite strict, we also can see how we can fit our national practice to fit the international standards. So working with those kinds of rules, and I'm glad it has been confirmed by other participants that you also work that way. that really helps. So I hope this helps you, I said. Yeah. Okay. Any other questions? Or are we all tired? Yes.
Thank you. My question is to the tax returns of individuals that you use in Netherlands and Iceland. In Armenia, we are going in 2 years to introduce the tax returns for individuals, for households. The question is, have you, your agencies, your institutions participated in the elaboration of this tax return? I mean, have you collaborated with the tax authorities just to use for the statistical purposes? I guess it's no, but I was discussing with my colleague, so that we shall somehow to be involved in this process. I don't know. Thank you.
I understand your question, and I wish I had, but we do not have an influence on the tax authority when it comes to income tax and income tax declaration. So we took the data as they come from the tax authority.
Yeah, the same.
So that will be useful for the financial accounts.
Yeah, but for in the Netherlands, yeah, but that's specifically in the Netherlands. In the Netherlands, you have a tax on wealth, so you really have to state in detail what your assets are. So, for example, I have to declare for all the bank accounts that I have, which amount is on the different bank accounts, and that also holds for loans and etc. So there's quite a lot of detail in the tax return.
Details that you use for the thank you.
Yeah, for Iceland, it is the same, pretty much the same thing.
Maybe to highlight that one thing is to contribute to the design of the form. The other thing is to get access to the information afterwards, which is not to be taken for granted. So in the euro area, we are working now on distributional wealth accounts to try to distribute the wealth across categories of households, and for that we would love to, countries would love to have access to tax returns, and most of them don't have. The Netherlands is one exception, and so they can build these distributional wealth accounts much better than the other countries. But for the others, I know countries that have been in negotiation with the tax authorities for more than a year and are still still don't manage to get the data. So yeah, one thing is the design, but just the access, if you can secure that, it's very helpful.
I was just going to add that in my former position, the agency was able to, they're allowed to get all the tax data, but it's a very good point that Pierre made. They're not allowed to change or make recommendations on the design, but they get access to all the data. That's the difference. And they have a steering committee, and the chief statistician sits in the steering committee for the tax authorities to make sure that, if they're going to implement, new information or new schedules, that first they have to discuss it with the agency to see if it's going to benefit all. So in Canada, it's a little bit different because the government pushes, the approach, collect once and to be used by all. So now the new legislation is that any government department that is seeking to expand its data holdings, they have to consult with the agency, not to change. The agency is not allowed to change, the format, but to make sure that if there's any data that could be used by the agency, it will be given to the agency. Yeah.
Okay. And to complete, that's a bit different than in the Netherlands because we have access to the data, and that we get that access due to the statistical law we have in the Netherlands. And there it says that every data the government collects from its citizens or companies shall also be shared with the statistical office. That's well short phrasing, but that's actually what's in it. But we do not have the power, and we're not consulted when the tax authority changes something. So for example, under COVID, the tax authority decided for VAT that some companies shouldn't declare VAT every month, but could do that every 3 months. And we were confronted with that, but we could not say, okay, this does not fit our statistical process, so you cannot do that, or please do not do that. We just had to take that and see how we take it from there. And that actually, well, created quite an issue for us, because especially for the short-term statistics, you can imagine that having monthly VAT data is much better than having every 3 months VAT data. So, but we do not. There's only one exception, but that's unemployment, but that's a long story. Okay, any other questions? No?